Filipino. Together. Together.
Yeah, guys. Right. So today what I will be doing is, I'm sure you guys know about something called the pre-mock, right? So ACCA, what they do is before every session, right? Before every session, so meaning December, March, June, and September, just before the session, 1 month ahead, they they what do you say? They release something called the pre-mock. So what is this paper? It is something that they expect you to time. Okay, so they expect you to time yourself and sit for the paper and mark it yourself and see if you are ready for the exam. Okay, now don't think that your real exam will be like very similar to the pre-mock. Okay, because if that was the case, then it doesn't make sense, no? Okay, in terms of the structure, in terms of the way in which the questions are laid out, all of that might be similar, but don't expect the same question to come from the pre-mock in your real paper, because the people who are making your real paper, they are the ones who make the pre-mock also. Okay, so actually what is this paper good for? It's good for practice, because they tend to ask as many areas as possible. Okay, so compared to your real paper, it might even touch more areas than usual, right? So today what we will be doing is we will go through that entire pre-mock. If you have any questions, you can ask me. They also release the answers, but they have video releases, but they don't touch every question. Okay, so that's why I want to do it in class. So each and every question is touched. And to be honest with you, this December session, for some reason, the pre-mock is very comprehensive. Okay, meaning we have questions from so many different areas. compared to the previous sessions, we have a lot of questions from different areas. So in terms of practice, in my opinion, it's a very good paper, right? So how do we access this pre-mock? So let me show you how that's done. Give me a second. Okay, so actually the easier way is go on Google basically. Okay, so click on the first link that you see, and you will be able to see access the pre-December mock on the practice platform, right? So that's where you need to go. And then put in your ACCA registration number and password. So at this point, I hope you are actually looking and using the practice platform, okay? Because it's not just a matter of, answering the questions. You should be able to put it in that Excel sheet or the word sheet that they're giving you, right? So that's very important. So make sure you do practice questions on the system, the practice platform itself. See, it's a little slow. Just give me a minute. I'll check if something's up with the net. Hello. Rashra, the internet is a little slow, I think. Yes. I need to get this pre-mark. It's taking a long time to load. All right, let's see. Is it okay? Yeah, can you check it? Yeah, I think it's fine. So I'll assign it. Yeah. Yeah. Okay, so once you get into this practice platform, we need to go to financial management and go for ACCA official resources and practice exams. Okay, so under that, you will have the FM pre-December 2024 mock exam. You need to assign that to yourself. Okay, so when you do that, that particular paper should fall under this self-assigned material. Okay, so it will be here. You can see you have FM pre-December 2024 mock exam. You can go ahead and start it. Right, so basically guys, what you see on the screen, okay, so there are two reasons why I did this paper. One is I want to make you familiar with what you will be seeing, right? But I believe most of you would have sat for, other papers. It's the same thing, nothing different, okay? So this is what you will see when you go for your exam as well. General instructions, you can read through it, and then, they're just telling you the different options that you have. You can highlight the question, you can strike through all of those things you can do. Okay, so play around with it, play around with a laptop. Okay, so don't use a tab or a phone. Most of the functions, they don't work properly with tabs and phones. Okay, so please use a laptop or a PC to actually get the feel of how this system works. Right, so let me start. Okay. So somebody sent me a message asking where the formulas are given, right? So I don't know if you can see here. I think I'm covering it. Yeah. So you can see here, right at the bottom, on the left-hand side, there's something called help or formula sheet, right? So if you click on that, you get these exam instructions. That's basically what you read just before you started the exam. Something called question help and something called a formula sheet. Okay, so what is actually important for us is this formula sheet. So whatever formulas that you need is available here. So the EOQ, Miller, or everything is there together with the tables, the present value table, annuity table. Okay. Right. So this is basically they're asking, they're showing you how to use the Excel sheet and how to use the word sheet. So just have a look at it before the exam. Don't go to the exam and waste time reading this. Okay. Exam instructions, like I said, what they actually displayed at the beginning, right? So then on the right hand corner, you can see previous next, that's the question. Navigator, if you click on that, you can jump to any question that you want. Okay. So let's say, for example, the exam, you have answered all the questions, just one question 4 you didn't answer. Then from the last question, you can directly jump to that question. You don't have to go back so many times. Okay. Then this flag for review, in case there is a question that you're not sure. Okay. Then what you can do is you can flag it and move on to the next question. So then what happens is when you open the navigator, now question 1 I have flagged, no, it will show as a red flag there. So towards the end of the exam, if you want to know, you want to go back to a question that you have incompleted, that is incomplete, you can simply click on that. So it acts like a bookmark. Okay. So that is that. And then you can highlight, strike through. You have a calculator here. If you want, you can use it. There is a scientific version as well as the standard as well. So it's up to you. But again, in my opinion, better take your own cal because you're comfortable with that. Okay. But suppose, it happens to people, battery doesn't work. Okay. Something happens to the cal. Then, unlike in the past, you still have a calculator. So no issues there. Scratch pad. This is actually important, especially in a situation where you don't have paper, pen and paper, right? Now, most of the time you don't get, okay? But you can request for it. But in case, I'm telling you, worst case scenario, you don't get it. Now, when you're doing MCQs, you can't do workings in your head, no? Okay, obviously it's not possible. You need paper, right? So in case you don't have that at your disposal, then you can use what is called the scratch pad. So basically, it works like a typing pad where you can type in whatever you want. Okay, so if you want to do certain calculations, you can do that using this scratch pad itself. Okay, right? Okay, so that's it for, just walking through the platform. So now let's go ahead and start. Okay. So if you look at the first question, this is obviously section A. You will have 15 short questions. The first question is saying, Cosmos company is exploring a new project with a lifespan of 4 years. The project promises robust returns of a positive net present value of 400,000 when discounted at an annual rate of 10%. Okay, so what are they saying? They're saying there is a new project, okay, and the lifespan of that project is 4 years. Fine. And they're saying that the net present value also we have calculated, it is 400,000 if we use the discount factor at 10%. Okay. These estimations are based on expected cash inflows of 500,000 annually over the project's duration. Tax is payable 1 year in arrears at a rate of 30%. So they're saying, how did I calculate this 400,000 positive NPV? I did that based on expected cash inflows of 500,000. So they're telling me that. Okay. And they're saying tax is paid in arrears. Fine. Question is, what is the change in the annual cash inflows which will make the net present value 0? Meaning, how much should these cash inflows change by if this positive 400,000 has to become 0? That's the question. Okay, so I'll give you a minute. If you can figure what exactly they ask, I'm using the exact word here. Okay, it's actually kind of tricky because they're not telling you what to do, but they have given you, the idea of what has to be done. The word itself is not used. Okay, what do you think they're asking to calculate here? When do we calculate when an NPV becomes 0? Something that was positive, it's going to become 0. In which method did we do that kind of a calculation? That's what you should be thinking at this point. Okay. So think through, and if you have an idea, let me know in the chat. Any idea? When did we calculate when an NPV becomes 0? Good. I have the correct answer from one person. Okay, so there was only one situation where we used to say this, right? If this particular variable changes by this much, NPV will become 0, project is no longer viable, right? So when did we talk about this? We spoke about it in an area called sensitivity analysis. So by default, if you do sensitivity analysis, what are you actually doing? You're calculating how much a particular variable has to change in order for the NPV to become 0. So that's exactly what they're asking. Okay, they're asking you to calculate how much should that inflow change by if the NPV has to become 0, right? So what you need to do is calculate sensitivity to that particular cash flow, right? So the equation that we used was this. Sensitivity equals to NPV over present value of after tax cash flow. I'm mentioning after tax here because they gave the tax rate. So chances are that we have to use that. Okay, if they didn't mention it, then we can just take the present value of the cash flow itself, right? So using this equation, we need to calculate sensitivity. Okay, so let me see what we have in the question. Right. So clearly NPV is there. Okay, so I'll highlight that. Let's see if I can, because again, like I said, I'm using a tab. Yeah, it's not possible to do it in the tab. In your exam, you can highlight, right? So NPV is there, and the cash flow that they're talking about is also there, 500,000 cash inflow. Okay, and we have the tax rate also. So get the present value of that 500,000 first. We know the lifespan is 4 years, and then using the NPV equation, using the sensitivity analysis equation, you can get the percentage. Okay, so I'll give you 2 minutes. See if you can do that. Okay, try it out. Okay, so let me get the present value first, but you have to be a little careful, okay, with regard to this present value. Right, so the question is saying the lifespan of this project is 4 years, right? So then what's going to happen here actually, if I'm going to get present value, I take the years. For 4 years, that is from year naught all the way to year 4, there is going to be a cash flow of how much they told me in the question. They told me there is expected cash inflows of 500,000 annually. Okay. So that will be there in the first 4 years. So that will be 500,000. Now I need to discount this. Now clearly this is an annuity. So I need to take annuity factor at 10% for 4 years. Okay. So I will go to the annuity tables. So 10%, how do I know it's 10%? They told me it's discounted at an annual rate of 10%. So that's why I know it's 10%. So if you look at the 10% 4-year figure, it is 3.170. Okay, so that is the annuity factor that I will use. 3.170. That will give me the present value. So let me get that figure first. So 500,000 into 3.17. So that will be 1,585,000. Okay. Now, usually if there was no tax involved, we can stop here. Okay. But here in this question, they're talking about a tax that is paid in arrears. So that means now there are 4 years anyways, right? But we don't start paying tax in year naught itself. We are going to pay 1 year later. Okay. So that means I'll just draw the timeline for tax. Year naught, year 1, year 2, year 3, year 4, and year 5 also I need. Okay. Now, how much is the tax that I'm going to pay? It's 30%, right? So 500,000 into 30%. Okay. So that will be the tax amount that I'm going to pay. So that will be 150,000. Now, this 150,000 guys, what is going to happen? I'm going to pay 1 year in arrears. So you have to be a little careful here. Okay. So it's what we call a delayed annuity. Okay, so it's called the delayed annuity. So I have 150,000, 150,000 and 150,000. Okay, so what I will have to do here, sorry, it's delayed now, so it has to go one to the right. Give me a second. Okay, so the first payment happens 1 year later, 150,000, 150, 150, and 150. Okay. So now if I want to make this 150,000 present value, first I have to take the annuity factor, and then that will only bring it back by 1 year. Okay. And then again, I should use the discount factor for 1 year and bring it back to year now. Okay. So be careful what you do there. Right. Okay. So let me look at the annuity factor table again. Right. So yeah. So if you look at how do we get the figure, is it going to be for 5 years or 4 years? I'm sure you know that by now. We know that we're talking about a 4-year period. I always say count the gaps. So 1, 2, 3, 4. 1, 2, 3, 4. Okay, so 4 payments, right? So we need to bring this back by 1 year. So for that, we take the annuity factor of 3.17. Okay, and that will bring it to year 1's terms. From there, we have to bring it to year naught. So what we do is we go to the present value table. Okay, and bring it back by 1 year, which is 0.909. Okay, so if you're not sure what happened here, please look at the first few chapters that we did where there was a topic saying delayed annuities. Okay, so what do you do when there is a delayed annuity, right? So this 3.170 is the annuity factor for 4 years. 0.909 is the discount factor for 1 year. Okay, right. So then what we can do is this 150,000, it's going to happen from year 2 to year 5. Okay, we will discount it by 3.170 into 0.909. Okay, so that should give me, I can do the multiplication and give the answer and then do the present value. Okay, so 3.17 into 0.909, that will be 2.882. Okay, so now the 150,000, I will multiply it by that. That will be 432,300. Okay, so now you can deduct the two figures. You will get 1,152,700. So that's going to be the present. Okay. Right. So you have the present value. NPV, you already knew it was how much? A positive 400,000. So to take sensitivity, it's 400,000 divided by 1,152,700 into 100%. So sensitivity will be 34.70%. Okay. Take it down. So you're saying option 1. Let me see what that answer was. 34.7 is actually option C. Okay, the answer should be C then. Is it clear? Any questions, guys? Okay, so that's how in this paper you will have a little tweaks here and there, right? Because now see, we have never taken two cash flows and done sensitivity before this, right? Except for when we used contribution. Okay, sensitivity to sales volume, when we use contribution, we consider the sales as well as the variable cost, right? But here now see in this question, they suddenly put in a tax component. Right? So that is the importance of practice. Get it? The more you practice only, the more you will understand how to tweak your answers a little bit. Because now see, unfortunately, this is an MCQ. Right? So even if you got the first part right, even if you got this 1.585 million, it won't make a difference anymore. Why? Because what's the point, right? Because you will do everything based on 1.585. You will anyway get the wrong answer. You will choose that and move on. How does the examiner know that you did half the question correctly? Right? So that's what I'm telling you. Always keep on practicing. MCQs are the place where people tend to lose marks because of lack of practice. Okay. Right. Let me know once you've done taking once you're done taking it down. Okay. Right. So that is the first question, right? So let me move on to the next one. Right. So select the answer and move on, right? Right. So here I'll just read the requirement and I'll give you some time. It says, should tech company plan to adapt its existing capital structure for the new investment proposal? Determine the revised cost of equity for tech company in the hospitality sector. So they're saying if should means if tech company plans to adapt their current capital structure, what will be the new cost of equity? So it's a risk-adjusted cost of equity calculation. So if you remember, you need to re-gear, de-gear, all of that, and then try to get the cost of equity using capital. Okay. So read through the question. This is something we have done many times. See if you can do the entire thing, right? Now again, you might think it's a big calculation, only 2 marks. What to do? MCQs are like that, right? Okay, so I'll read through. If you're comfortable, continue. Okay. It says tech company, a successful software company seeking to diversify into the hospitality industry amidst the market saturation in their current sector. Okay. So they're saying there is a company. Okay. I'll just explain the situation first. There is a company who is currently in, I can't remember what was the sector. They said they are a software company and they are trying to diversify into the hospitality sector. Okay. Then they're saying tech company aims to ascertain its cost of equity for evaluating the new investment proposal. So they want to see the cost of equity in the hospitality industry. So there is another company, Sunshine Company, a listed company who is already in the hospitality industry. The existing capital structure and the equity beta of the two companies are as follows, right? So for tech company, you have a debt equity structure of 1:2. So everyone, if debt is 1, equity will be 2. And the equity beta is 1.5. Sunshine also you have 2:3 and 2. Assume there is no corp tax, the risk-free rate is 3% and the market risk premium is 5%, right? So I have explained this almost every day in our revision. Okay, I'll go through it once more as well. So there is a company called Tech Company. They are currently in software. They want to diversify into hospitality. Okay, we know that software and hospitality, both those industries, they have what we call the business risk as well as the financial risk. Hospitality also has the same business risk and the financial risk. Now, they gave me tech companies equity beta. They told me that tech companies equity beta is 1.5 currently, right? So, this 1.5 is reflecting business risk of software plus financial risk of this particular company. The financial risk was that 1:2 structure. Okay. Now, when they are going to diversify into hospitality, it doesn't make sense to use this 1.5 anymore. Why? Because although the financial risk is still the same, business risk changes because now the industry is changing. Right? So business risk will obviously change. It doesn't make sense to use the same 1.5. So now what are we going to do? We are trying to get the business risk of the hospitality industry. So how do we do that? We take somebody who is already in that industry, in this case, Sunshine Company. Okay. So the question is telling me Sunshine Company, they had an equity beta of 2. Okay. So they have an equity beta of 2 means this 2 is reflecting the business risk of hospitality, which is good. We want that. But the financial risk of Sunshine Company, which we don't want because we don't have this 2:3 structure. If you look at Sunshine, the debt equity structure is 2:3. Ours is 1:2. So we don't want that 2:3 financial risk, right? So what do we have to do, right? What do we have to do? We need to somehow remove the financial risk component. So that is only called de-gearing the beta. Okay. So we take this equity beta and we de-gear it. Okay. We get something called the asset beta. Then what do? We re-gear that asset beta to reflect our company's financial risk. Okay. So that is what basically has to be done. So first step is to de-gear Sunshine Company's equity beta. That is only step number 1, right? So there is an equation for this. Okay. There is an equation for this. You can look at your formula sheet. Okay. You can see the asset beta formula, right? So usually for the purpose of our exam, we only consider the first fraction. Okay. So this value of debt part and the beta debt, all of that, you can completely ignore it because we make an assumption in this paper that beta debt is always 0. Okay. So just the first bit of the equation you need to use to go ahead and do the de-gearing. Okay. So let me copy down the question. Sorry, the equation. So equation is this: beta asset equals to the value of equity over value of equity plus value of debt times 1 minus t into beta equity, right? Fine. So if you look at Sunshine, their equity debt ratio was 2:3. Okay, so that's what we need to use. Value of equity, value of debt, you can use the ratios. So 2:3 and equity beta was 2. And which one was 1? Yeah. So debt is 2, equity is 3. Okay, so be careful, don't put it the other way around. So equity is 3 over value of equity again 3 plus value of debt is 2 times, they're telling me to ignore tax, so I can just ignore it. Okay. Into the beta equity was 2. Right? So that will give me beta asset, which is 1.2. The degearing is done. Now, next step is to re-gear. Beta asset. For that also you use the same equation. Okay. Actually, since they told me to forget about debt, let me just remove this because you might get confused and make that 2 also 0. Just take it as 3 plus 2, 5. Okay, so now let me do the re-gearing. How do I do that? Okay, so same equation that we have on top, right? Same equation. This equation has to be used, okay? So this time we have beta asset, which is 1.2. Now value of equity, now we have to take the equity debt ratio of our company, which was 1:2. Okay, so if you remember, it was 1:2, right? Equity was 2, debt was 1. So value of equity is 2 over 2 plus 1 into beta equity. That's what we want to find out. Okay. So once you rearrange this, you should get beta equity as 1.8. Finally, use the capital asset pricing model to find KE. So KE equals to risk-free rate plus beta equity times risk in the market minus risk-free rate, right? Question told me that the risk-free rate is 3%, risk premium is 5%, right? So 3 plus beta equity is 1.8 into risk premium. They told me it was 5%. Remember, RM minus RF is also called risk premium. So if they give you risk premium, you can directly put that figure itself. That should give me the cost of equity. Should be 12. So always you have these 3 steps. Okay, degearing, regearing, and then using capital. As if you'll have questions, please let me know, okay? Just like I said, this question is a little, this question paper tends to be a little on the heavier side for some reason this session. Heavier side as in they're asking a lot of calculations. So next week we'll have another mock. Okay, it will be entirely online. You can try it out, send me the answers. I will, I'll send each of you a personal email, giving you feedback with regard to your answers. Okay. Right, so KE is 12%. We'll see if that answer is there. Okay, so we just have to type in the answer in this case, right? So Right, so 12%. Next. Right, so now they're asking you about current market value of a loan note. Okay, so loan note market, right? It says there, Bubblegum Company has 12% convertible loan note. So it's a convertible loan note outstanding, maturing in 5 years' time to be redeemed at face value of $100 per note. Alternatively, each note can be converted into 40 ordinary shares each with a nominal value of $1 after the 5-year period. The company's ordinary shares are presently trading at $2 each, projected to grow at an annual rate of 5%. The pre-tax cost of debt is 10% and the after-tax cost is 7%. Okay. Now, it's a convertible loan note, right? So you have two options. In 5 years' time, if you want per loan note, you can go for redemption. That means for every loan note, they will give you $100 and call it a day. That is one option. Or you can go for a conversion, meaning instead of taking the cash, instead of taking the $100 per loan note, you can convert one loan note into 40 ordinary shares. So when will you do the conversion? When you do the conversion, if it happens to be more than $100 per loan note, what you're getting happens to be more than $100, then you will be more than happy to do the conversion. Okay, so this is a classic example of how to get market value of a convertible. First, you have to decide whether you're going to redeem or whether you're going to convert. After that, get the market value. So market value, if you remember, it was similar to like getting a present value calculation. Okay, so see if you can do it. I'll give you 5 minutes. This is something again we have done so many times. Very simple. Option 1, which is, you're saying it's 122. Okay. Okay, so let me first decide what the conversion value is. Okay, because that's the first step now. See if I can use this now. Yeah. So conversion value. So this conversion is going to happen in 5 years' time, right? So first I need to figure out in 5 years, what will be the market price of a share in this particular company, right? So they're telling me the company's ordinary shares are presently trading at $2. So currently it is $2, but it's going to grow at an annual rate of 5%, right? So I'll multiply that by 1.05 to the power. How many years am I talking about? I'm talking about 5 years. Okay. So that is going to be the price of a share. Am I going to get one share? No, I'm going to get 40 shares, right? So let me multiply that by 40. So the conversion value will be $102.1 per loan note. Now compare this with the redemption. Redemption is $100, right? So since conversion is going to be more than redemption, the shareholder, sorry, the debt holder will choose the conversion option. Okay, so now we know that we are going to convert because it's more. Okay. Right. So we have decided that we're going to go for conversion. So now just a matter of getting the market value. So how do we do that? Okay. So conversion is going to happen. Right. So we have our years. Year 1 to year 5, there will be an interest payment. Now, usually we take interest times 1 minus t, right? But in this case, if you see the question, okay. If you see the question, they don't give me the my tax rate, right? So because of that, we don't have a choice. We have to just use the normal interest, right? So which is going to be 12%. So 12% into 100, 12, right? But be careful. If you're not going to use interest 1 minus t, you can't use the after tax percentage of 7 because we did not include 7, right? So that's the reason they have given pre-tax also. So in this case, since we are not making the adjustment for taxation, the rate that we are going to use for discount factor also has to be pre-tax rate, which is 10%. Okay, so be careful there. So the interest is going to be 12. And in year 5, we will go for conversion, which is 102.1. Okay, so then you need to, these are the cash flows. Yes. Then you need to use either the annuity factor or the discount factor at 10%, the pre-tax rate. Okay. Right. So 5 years annuity factor at 10% will be 3.791. And 5 years discount factor at 10% is 0.62. Get the present value. This will be 45.492. This will be 63.4041. Take the total, that is the market value, which is 108.89. I think they told you to the nearest dollar, right? So 108.89 means 109, which is, I think, C. Yeah, C. Okay. So this is just a normal market value of a convertible. Only thing is in this case that tax, usually we are so used to taking the after tax rate because we are thinking from the perspective of the company, right? But in this case, since the tax rate is not there, we don't have a choice. Right. So let's look at the next one. It's 109. Okay. Then they're saying here, what is the amount of equal annual lease payment for 4 years closest to? So they're talking about a lease. Okay. The net present value of a lease agreement calculated at a 10% discount rate yields a negative value of $21,003. Okay. If you're going to get the present value of the lease payment, it's going to be $21,003. Fine. The terms of the lease involve an immediate down payment of $10,000 followed by 4 equal annual payments with the first payment commencing at the end of the first year. Okay. So there are 2 payments that are happening as in any lease. First is the down payment itself, which will usually happen in year 0. Okay. And then year 1 onwards, we are going to pay these installments, the lease payments. That is, they're telling me 4 equal annual payments. They are not telling me how much that lease payment is. So the question is asking me basically, what is that lease installment that we have to pay for 4 periods, right? So that's what they're asking. They have given me the NPV. They're telling me if you take the initial investment and the lease payment and get a present value, answer will be minus 21,003. Okay. So how do you think you can figure out what the lease payment actually is? So I'll give you a hint. Start with drawing the timeline. Any lease payment, that's the first thing. Draw a timeline and see what's going on. After that, things will kind of fall into place, right? So I'll give you 2 minutes. See if you can figure out what actually has to be done here. Okay, so like I said, get the timeline done first, okay? Okay, so this is the timeline. So we have year naught, year 1, year 2, year 3, and year 4, just 4 payments, right? So the initial down payment, they told me it was 10,000. So that will happen immediately. I'll just check if it's 10,000. Yeah. Initial immediate down payment 10,000 followed by 4 equal annual payments, right? So the 4 equal annual payments, there will one payment will happen here, lease payment 1. I'll call it lease pay 1. Then lease pay 2, lease payment 3, and lease payment 4. Okay. So all of this, okay, all of these will be one figure. Okay. So I can just call it X because it will be a fixed amount every year. Okay. So 4 different payments will happen. Okay. Right. So now they're asking me basically what is the answer for this X, right? We have the NPVs. So let me put the NPV structure down first. So I have years. Okay, in year naught, I have the initial down payment of 10,000. And then from year 1 to year 4, there will be this lease payment, which I'm going to call X. Okay. Right. So now let me get the net present value, right? So I have the cash flow here. Let me discount it using either the discount factor or the annuity factor at how many percent? I think they told me. Calculated at a 10% discount rate, right? So 10% present value. So here not always is going to be 1. So this will be a minus 10,000. Okay, now I need annuity factor at 10% for 4 years, right? So that I can go to the table and get 10% annuity factor for 4 years is 3.17. Okay. Now I don't know what this answer is, but they told me that after everything is done, the net present value, the answer will be negative 21,003. They told me that. Okay. So now I just need to work backwards, right? If this is 10,000, what should this figure be in order for the answer to become minus 21,003? So very clearly, if this was minus 11,003, minus 10,000 minus 11,003, I will get my answer minus 21,003. Okay. So now work backwards. X into 3.17 should give me an answer of 11,003. So if I want X, what should I do? 11,003 divided by 3.17. So X will be 3471. That is only the annual lease payment. Okay. See, it's a simple thing. It doesn't strike us at the beginning. That's the only difference, right? So how do we make sure that we get it at the exam? You have to start somewhere. That's what I said. Start with the timeline. Okay, once you get the timeline, the next thing is, there is an NPV, right? So put the NPV structure, maybe something will click, right? This is not something we have done before, but this is actually the simplest form of lease, actually. Think about it, right? So just a matter of starting it off. If you're scared to start, it will not click you. Okay, right. So 3471, let's see if that answer is there. 8. Okay, if you want to take it down. Okay, let's move on to the next one. It's saying indicate by clicking on the relevant boxes whether the following statements are true or false relating to working capital. Okay. First is saying the two primary objectives of working capital management is to balance between profitability and liquidity preference. That is true, right? That is what we actually do when it comes to working capital management. We are focusing on balancing profitability and liquidity. So that's true. Then the next one is invoice discounting is usually performed on the entire receivables ledger. Invoice discounting, if you remember, if you have a lot of invoices, meaning you have sold the goods, people have to pay you, right? So you have issued the invoice. You have so many invoices, let's say 10 invoices. You want the cash immediately. But obviously the customer is not going to pay immediately, right? Because you gave a credit period. Now what you can do is you can take those invoices and show it to somebody called an invoice discounter, keep that as a guarantee and take a loan, a short-term loan, right? So here they're saying usually invoice discounting, we do it for the entire receivables ledger. That is wrong. We usually can pick a few invoices, maybe 2 or 3 invoices, and then we show those invoices and ask for the advance, right? So not the entire ledger, just a few invoices is what we use, right? So this is false. Third is saying an aggressive approach to working capital financing can increase profitability. I'm sure you know this. Aggressive nature means we don't care about whether we have cash in hand for any emergency. Okay, we just want profit. Okay, so we want to focus on profitability. That is what we do if we have the aggressive approach. So that is true. Conservative, on the other hand, means we are a little scared. Even if the profit is a little low, it's fine. We don't want to come to a situation where we don't have cash when we need it. Okay. So if you're conservative, you will focus more on liquidity rather than profitability. Finally, a disclosed factoring arrangement will be an advantage to the seller in upholding its business reputation. So disclosed factoring means you are telling your customers that now onwards we are using a factor to collect debts. They're saying that's a good thing for the reputation, which is definitely false. Okay, because if you are going to tell that you are going to use a factor, most of the time there is this assumption that only if a business is not doing well, we go for factoring arrangements. So the moment your customer knows that you're using a factor, they might think, okay, they're going to go bankrupt. So business reputation wise, it actually is not a good thing for you. So not an advantage, right? So that's false. There will be true, false, true, false. Okay. So when you use a lab, see true, false, true, false. Okay. That's how when you click, it will appear in red. So that means you have selected the answer. Okay. They're asking for a theoretical X rights price. Seems simple. Write it. There is an equation. Start off by writing the equation and see whatever you need to input into that equation. Okay, I'll give you 5 minutes. Okay. It says no company intends to initiate for a 1:3 right issue, offering shares at a 20% discount to the current market price. Presently, the company's EPS stands at $2, with shares trading at an earnings yield of 5%. Additionally, Snow Company's market capitalization is valued at 240 million. So they're asking for TERP rounded to the nearest whole number. Fine. So first step, guys, honestly, is to take down the equation, right? Because only then you will know what you're looking for, right? So TERP is the market value of shares already in issue plus proceeds from new share issue divided by number of shares after rights issue. Okay. So market value of shares already in issue. Let's see if that figure is given to us, right? So they're telling me additionally, Snow Company's market capitalization is valued at 240 million, right? So how do we get market capitalization? The market price of a share into the number of shares. So that is only the market value of all your shares outstanding, right? So the first part, actually, we have the answer directly. 240 million. Proceeds from the new share issue. Okay. So if I need to know the proceeds from the new share issue, first of all, I should know how many shares did I issue in the first place. Okay. So if you see here, it's a 1:3 rights issue offering shares at a 20% discount to the current market price, right? So first thing I will do is let me try to get this current market price. I don't have it. Okay, I have the total market value, the 240 million, but per share, I don't have the figure, right? So they're saying presently the company's EPS is $2 with shares trading at an earnings yield of 5. So chances are that that information is what I need to use to get this market price of a share. Okay, current market price of a share. Now there is an equation like this, right? The market value of a company equals to the total earnings divided by earnings yield. Okay, we learned this in the chapter business valuation. That is the equation like this. Okay, now we don't have total earnings figure, but we have earnings per share, right? So I can tweak this a little. So instead of saying market value of the whole company, I can say the market price of one share equals to the earnings per share divided by earnings yield. Okay, so this was the whole company. So if I want for one share, instead of taking all the earnings, I will only take the earnings of one share, earnings per share. Okay, so now I know the EPS. They told me it was, I think, $2 and the earnings yield is 5%. So $2 divided by 5%. The market price of a share is 40. Per share. Okay, that's the first thing. Now I have the market price of the share. I have market capitalization also. Okay, so market capitalization is the market price of a share into number of shares, right? So I know market capitalization already, it's 240 million. So I'll just get the number of shares also, 240 million. 40 into number of shares. So number of shares in issue will be 240 million divided by 40, which is 6 million shares in issue. Okay, so this is without thinking about any of the rights. Okay, so only thing I did here was I got the market price of a share using the market capitalization and the market price per share. I got the number of shares in issue. Okay, so now I have to decide what is happening with regard to the rights. Okay, So take this down first, and then I will show you what happens with the rights. Sure, this is before rights. Okay. Okay. Now let me read what they're talking about the rights issue. They said it's a 1:3 rights issue, and the price is at a 20% discount to the current market price, right? So the rights issue, how many shares? 1:3, right? So rights, we have 6 million shares in issue. If you divide that by 3, you will know that we are going to issue 2 million shares under the rights. Okay. And what is the price we're going to issue at a 20% discount, right? So currently it's $40 per share into 80% will give you the discounted price, which is $32 per share. That's the rights issue price. Okay. So now we have everything that we need for the TERP. Okay. So let me go here. Market value of the shares 240 million. That's fine. Proceeds from the new share issue. So I'm going to issue 2 million new shares and each share at $32, right? So this will be 2 million into 32. And number of shares after the rights issue. Before rights, I had 6 million. After rights, I have 2 million. So 6 plus 2 will be the number of shares after. Okay. So if you want the TERP, I put it on this side. It's 240 plus 64 million divided by 678 million, which is $38 per share. Okay, so always work step by step. Okay, based on what the question is giving you, see what can be calculated. Okay, so from that point, because now see, the moment you see earnings yield, this equation should have struck you. Because in our entire syllabus, earnings yield, we only spoke about in one place, in business valuation, and we used it to calculate market value of a company. So if they're giving me earnings yield, I have to somehow use that. So the only equation that will work out is this one. So once you figure out that it's going to be from the business valuation part, everything else will start falling into place. Okay. Right. So $38 per share. Need to put that here. So just the numbers, right? Don't put per share and okay. Which two of the following statements regarding financial markets and economic policies are correct? They're saying higher taxation is expected to boost overall demand within the economy. Now, if you have a lot of tax, you and I, we have to pay more taxes. So then the disposable income that I have in hand is going to reduce. So when I have less money to spend, obviously the demand is not going to get boosted, no. Only if I have a lot of money to spend, the demand in the economy will get boosted because I want to go and buy things. So what they're saying here is actually not correct. If there is higher taxation, it's not going to boost the overall demand in the economy. Okay, so that can't be an answer. Then it's saying supply side policies will lead to raising the capacity of the economy in producing more goods and services. That is actually true. So supply side policy, actually what we're trying to do is, we try to help the private sector. We try to do something to increase the capacity of our economy. Okay. So if you're going to have a supply side policy, you're actually trying to increase supply. So when that happens, the capacity or the goods producing capacity will actually increase, right? So that is definitely correct. Maximizing market share is an example of a corporate's financial objective. Not really. Financial objective has to have something to do with profits. Okay. So this is not that. D. Peer-to-peer allows people to lend money directly to small businesses without going through a formal financial institution. That is true. Instead of going through a bank, if you know the person directly and they are willing to lend you the money, then you get the finance that you want without an intermediary. Okay, so that is correct. So answers there will be the second one and the fourth. Okay. Which of the following statements regarding value for money is correct? I hope you know what's value for money. Value for money is how to measure the performance of a not-for-profit organization. So there are 3 E's that we have to consider: economy, efficiency, effectiveness. Okay. So which of the following is correct? Number 1, acquiring resources at the lowest cost. Is this one of the 3 E's? Is it one of the 3 E's? Getting your input, your resources at the lowest possible cost? Yes, right? It is economic, right? So yes, the first one is there. Implementing innovative marketing campaigns, it has nothing to do with efficiency or effectiveness. So can't be that. Maximizing shareholder dividends also, no, not part of value for money. Ensuring maximum output with the given resources, that is only economic, right? So with what we are going to input, we want to take the maximum out of it. So that is economy. So 1 and 4 is correct. So answer there is D. Okay. In a booming stock market, investors observe rapid price fluctuations following the release of listed companies' annual reports. So they're saying after the annual reports are released, the prices are fluctuating. Which form of market efficiency best describes this phenomenon? Okay. So if we are going for a weak form efficient market, even after these reports are issued, there won't be much of a price fluctuation. Okay, if you are going for semi-strong form, then actually, yes, if there is publicly available information released, it will reflect in the share price. Okay, so answer there is semi-strong, but look at strong form. If it was strong form, guys, even before these annual reports are released, when it was private information, only people within the organization knew about it. Even at that point, the market is actually very efficient. So the prices would have actually reflected whatever is said in those annual reports. Okay. So weak form means it does not reflect even after the public information is released. Semi-strong form, it will reflect after public information is released. Strong form, it will reflect even once the information is private. Okay, so this will be semi-strong. Okay, what's the cost of equity of purple company? Very simple. They're asking cost of equity. In our syllabus, there are only two ways to calculate it. One is dividend valuation model. Second one is the capital asset pricing model. CAPM. Okay, so one of the two. I don't see anything to do with CAPM here. So most probably we have to use the DVA. Fourth one is efficient. I know the question you're talking about, Yumna. 1 second, guys. Did I say something else? So first one, acquiring resources at lower cost is economy. 2 and 3 is not part of value for money. Ensuring maximum output is efficiency. Did I say economy? I'm sorry. Okay, it's efficiency. Effectiveness means the output will be in line with the company's main objectives. Okay, so first is economy, fourth is efficiency. Effectiveness, they have not mentioned in this question. Okay, sorry, okay, if I said something else, I might have said economy, I feel. Right, so cost of equity, clearly using dividend valuation. Take some time, see if you can do it. It says here, Purple Company, which is about to pay a dividend, typically offers a dividend yield of 10% based on its ex-dividend share price. The current market price of its shares is $55 cum dividend, right? So whatever you're doing, we have to first of all convert that to ex-dividend, okay? But unfortunately, we don't have the dividend figure, okay? Because if they said, okay, dividend is $2, then 55 minus 2, 53 is ex-div. But here we don't have, okay? Then they're saying, company has 2 million shares in issue. They have a payout ratio of 20% and a return of 15% on its equity. What's the cost of equity of Purple Company? Okay. Right. So what I will do is, I know I have to use dividend valuation model. So let me start by writing down that equation. Okay. So I need the cost of equity using dividend valuation model. Okay. Right, so they're asking me for KE, right? So the best option is to write it in this method. I'll show you the formula sheet. Second, it's a little slow. So they're asking for KE now. So instead of writing the first one, it's better to write the second one. KE equals D naught times 1 plus G over P naught plus G. Okay, so let me write it that way. Okay, right. So the dividend is not very clear because I don't have it directly with me, but they are asking for growth also. No? So let me do what I know first, right? So let me calculate growth. I can either use two methods, extrapolating past dividends or using Gordon's growth model. Here they're giving me the payout, they're giving me the return on equity. So clearly I have to use Gordon's growth model, right? So let me do that. Okay, so G equals B R. Right, so I know that the payout rate was 20%, meaning retention will be 100 minus 20, which is 80%. Return on equity, I think they already told me it was 15%. So to get growth, it's just a matter of multiplying 15% into 80%, which is 12%. That's the growth rate. Okay, so I hope you have that taken down. Okay. Fine. So now I need what else? I need the dividend and I need the market price, the ex-div market price. Okay, so let's see what I have here. They're telling me the current market price of its shares is 55 cum div. Okay, so I know that the dividend yield is 10%, right? So 55 is talking about including that dividend, right? So 10% means what I'm trying to say here is the cum div price, which is 55, is when we're talking about 110% because it's including the dividend payment. What was the dividend payment? The dividend yield was given to me. It was 10%. I want to know what is the dividend. I want to know the ex-div, meaning how much this market price will be after I deducted the dividend. Okay. So 55 is when it is 110%. How much will it be when it is 100%? Okay. So 55 divided by 110 into 10. Oh, 1 second. Get that figure. Okay. Sorry, into 10, right? I just want to know what is that 10%, the dividend portion. So the dividend portion you can calculate, it's actually $5. Okay, so I'll repeat what I did here because we don't do this very often, right? We know that the cum div market price of the share is $55, meaning the market price plus the dividend is going to be 55. I know that the dividend is 10%. So 55 is including the 10%. So that's why I'm dividing it by 110. If you want to know what that 10% component is, you have to multiply it by 10 again. So now I know that $5 is the dividend that I paid. Okay. So now if I want the ex-div share price, all I need to do is ex-div market price of a share, that is simply 55 minus 5, which is 50. Get it? Okay, so now it's just a matter of putting this into this main equation over here. So I'll take it again. KE equals to dividend. I know we paid a dividend of $5. 1 plus growth rate is 12% over XD market price is 50 plus 12%. So that will give me KE, which is 23.2%. Yes, that will be the cost of it. Okay, if you have questions, ask me. So again, here everything is fine except for the fact that what did they complicate here? They didn't give me the exchange market price. They will do something like this, right? This paper is a little more on the heavier side. Yeah, I do agree. In your real paper, you can't expect every question to be a calculation like this, right? There won't be time, right? So it's a mock exam, right? So they want you to cover all areas as much as possible. Okay. So you can expect in your exam, I think we did a paper last week, if you remember. Let me think. Did we do a paper last week? There was a particular day, right, where we did a paper. Was it last week or the week before? I can't remember. But there you would have seen section A was slightly less calculations, right? So here you can see every question is a, one was convertible loan note, then DBM, and then de-gearing, re-gearing. So basically everything under the syllabus is given. Okay. The reason for that is because they want you to touch everything before your exam. Okay. So your paper, I'm sure, will be a little less heavy, right? Okay, right. Let's quickly finish this off. But yeah, even the next one is a long question. Let's see what it says. So this will be 23.2, right? B. It's to do with working capital management, right? So it says Cyprus Company's management has an annual credit sales totaling 50 million with accounts receivable amounting to 10 million. Working capital is funded through an overdraft at an annual interest rate of 10% and the company's cost of capital is 13%. Assuming 365 days in a year, what would be the yearly reduction in finance cost if the management shortens the collection period by 40 days? So this is a cost versus benefit analysis. It's part of working capital management. Okay, so see if you can do that. There were about 5 steps. I gave you the steps. If you follow them, you should be able to get that reduction in finance cost. So this is not the benefit section, right? Benefit we are not doing here. This is the cost. Okay, so the first step is you need to calculate the receivable days. Okay, so I know that the credit sales is 50 million and the receivables is 10 million. So current receivable days has to be calculated. That is step number 1. So let me take that down. Existing receivable days. Okay, so receivable days, there is an equation equals to receivables over credit sales into 365. Receivables, they told me it was 10 million, sales is 50 million. So 10 divided by 50 into 365. So existing receivable days is 73 days. Okay, first step. Then they are saying this particular company, they are going to reduce the receivable days to by 40 days. Okay, so now it is 73. They are going to reduce it by 40 days, right? So the new receivable days is actually new receivable days. It will be 73 minus 40, which is 33 days. Okay. Now, if the receivable days is going to change, then the receivables figure will also change, right? So that also we have to cater now. So new receivables figure. So same equation I'm going to use. If the receivable days is going to be 33, how much will the receivables be? Divided by sales is 50 into 360. So new receivables will be 4,520,540. Okay. So what used to be 10 million, the receivables used to be 10 million, it is actually reducing to 4.5 million odd. Okay. So now you can take the reduction in receivables. $10 million used to be minus 4.5, 4,520,548. So reduction is 5,479,452. Okay, so your receivables will reduce by this amount. Why? Because people are going to pay you early. Okay, so if it reduces, then you don't need to take an overdraft. So you can save on your finance cost. So they told me that the overdraft had a finance interest rate of 10%, right? So this reduction, it will save you interest of 10%. So reduction in finance cost, that will be 5,479.52 into 10%. So we're talking about 547,940. That's the answer. Okay, so it's a very classic example of the cost versus benefit analysis. Take it down if you haven't taken it down yet. Okay. So that will be, the answer will be C then. Right. Something to do with the FRA. Okay, so it's saying company a manufacturing entity finds itself in need of a 4 million loan for a 6-month period, which it requires in 3 months' time. So meaning, we don't need it today, we need it in 3 months' time. So for example, now we are in the month of say November, December, January, February. We need it in February for a period of 6 months. So from February, March, April, May, June, July, August. From February to August, we need that loan of 4 million. Okay. To mitigate potential risks stemming from interest rate fluctuations, they are considering a forward rate agreement offered by another bank with a quotation of a 3 to 6 forward rate at 11% or a 3 to 9 forward rate at 12%. Should the loan interest rate on the date when the loan is taken up, should the loan interest rate on the date when the loan is taken up is at 10 million, is at 10%. I'm sorry, I don't know why they keep using the word should. Okay. So they're saying if on the date that you're taking the loan, if the interest rate in the market is 10%, what is the payment or receipt company A will make or receive with the FRA bank? So they're saying we are taking the loan from one bank, we are taking the FRA from another bank. So if the actual market rate was 10% on the date of the loan, will we be paying extra to the FRA bank or will the FRA bank pay us some amount? That's the question. Okay. So it's a very simple scenario of FRAs. Okay. So see if you can get that answer. So first thing is you have to know which FRA to choose. There are two, no, 3 to 6 and 3 to 9. So if you don't know what 3 is and what 9 is, then you have a problem, right? So we want the loan in 3 months' time, right? So that is what the first number is talking about. So the loan is going to start in 3 months' time for a period of 6 months. That means 3 months plus 6 months, the total of 9 months from today. After 9 months from today only, we will end this loan, right? Okay. 9 months from today only, we are going to end this loan. So that means we need to go for a 3 to 9 FRA. 3 to 6 means we are going to start in 3 months time and end in 6. We are going to start in 3 months from today and end in 6 months from today. Meaning the loan you will only have it for a period of 3 months. That's not enough for us, right? So the FRA that you will have to choose is 3 to 9 FRA at 12%. So it's a 3 to 9 FRA at 12%. And now what's happening? The market rate happens to be 10%. Okay. So that means what's going to happen? You have told the bank, I will pay 12% and fixed it. Okay. When you take the loan, they are only charging you 10%. So that extra 2% that you promised to pay, you have to actually pay them. Right. So the amount that you will have to pay the bank, A pays bank an extra 2%. So the loan was for how much? I think it was 4 million, right? Let me check that. How much the loan was for? 4 million loan for a 6-month period, right? So you have to consider that 4 million into an extra 2%, but only for a period of 6 months. Okay. So that will be 0.04 million. So you can put it as 40,000. So A pays the bank 40,000. Is B. It's simple. Right. Let's go to the next one. Indicate by clicking on the relevant boxes in the table below whether each of the following financial instruments that are commonly in use by organizations are short-term or long-term financing, right? Okay. So we can go through this quickly. Commercial papers, usually they are short-term. Okay, I have mentioned this at the beginning itself. They're usually short-term. Preference share capital, the moment we're talking about shares, we're talking about long-term. Treasury bill, this is something that, the government, if they want a loan, they will issue something called a treasury bill. Public can buy it. Government will pay interest for a fixed period and then they will repay the principal. Usually, this is not long-term. Okay, so it is considered a short-term source. And the banker's acceptance is also short-term, right? So the answers there will be short-term, long-term, short-term, short. Okay. The next one. Which of the following statements accurately describes the differences between the traditional theory and the Modigliani-Miller theory regarding capital structure? Okay. So immediately you have to kind of see the graph. Okay. So if you're talking about traditional theory, what are we actually talking about? We're talking about this situation. So I'll just draw it. The cost, sorry, this is straight line, cost of debt, WACC, and the cost of equity. Okay. So what is the situation? WACC actually dropping to some extent until the optimal capital structure, and then it starts increasing, right? So this is the traditional view. So let's see which of these four is actually describing that. So first one is saying traditional theory assumes that the cost of capital remains constant regardless of the capital structure, while Modigliani and Miller suggests that the cost of capital increases with higher levels of debt due to financial risk. Now, even before I read the Modigliani and Miller story, they are saying traditional theory, cost of capital or WACC, weighted average cost of capital, it's constant. That's wrong, no? Regardless of capital structure means they're saying whatever the debt percentage is, doesn't matter, it's going to be the same, which is wrong because in traditional theory, it was a U shape. Okay, so I don't have to waste time thinking about Modigliani and Miller. I can definitely cancel that off. That is not an answer. Okay, so A is wrong. Then B is saying the traditional theory asserts that the value of the firm is unaffected by changes in capital structure. Now, if the WACC is itself going to change, weighted average cost of capital is going to change, market value of the firm will also change. There was a an inverse proportional relationship between the two, right? So we said that if the WACC is higher, market value of the company is lower. If the WACC is lower, market value is higher, right? So definitely them saying that the value of the firm is unaffected is wrong, because if WACC is getting affected, market value will get affected. Right? So B is also definitely out. C is saying the traditional theory emphasizes the importance of minimizing the WACC through optimal capital structure decisions. That is true. We try to minimize the WACC by keeping our optimal capital structure, while the Modigliani and Miller theory argues that capital structure decisions are irrelevant to WACC in a perfect capital market. So if you take M&M without tax, M&M without tax, if they're talking about tax, they will say M&M with tax, okay? So here they're talking about M&M without tax. Actually, M&M without tax, it said that the capital structure is irrelevant to WACC. Why? Because although cost of debt is cheaper, the cheaper debt will be counteracted by the fact that cost of equity will start increasing. Right? So what they're saying there is actually correct. It is irrelevant. Okay. So C seems to be the answer. I'll read the other one as well. The traditional theory advocates for maintaining a balanced mix of debt and equity to maximize shareholder wealth, whereas M&M suggests that the firm should minimize financial risk by avoiding debt. That's wrong. Okay. Because in M&M with tax or without tax, they didn't say avoid. In fact, in the with tax theory, they're saying go for 99% debt, right? In the without tax theory, they said it doesn't matter. Whatever debt you have, whatever equity you have, it doesn't matter, right? So nowhere does M&M mention that you have to avoid debt. That is completely wrong. Okay, so the answer there will be C. Right, so this is the last question under section A. It's saying the current euro US dollar exchange rate is $2 to the euro. ABC is a Eurozone company making $1,000 sales to a US customer on credit. By the time the customer pays, the euro has strengthened by 20%. What will the euro receipt be? Euro has strengthened by 20% means you have to first figure out, okay, what is the new exchange rate? After that, you can figure out that $1,000, when I convert it to euros, how much will I get? Okay. So they're saying euro is strengthening by 20% means now 1 euro bought me $2 before. If the euro is going to become even more stronger, then that same euro will give me more dollars, right? So $2 will become 20% more than that, right? So let's see what the new exchange rate is going to be. Right. So currently it's like this, but now what's going to happen? Euro is going to strengthen, right? So euro strengthens, meaning now with 1 euro, I will get more dollars. So how much more? 2 into an extra 20%, right? So I put it as 120%. It will become $2.4 for the euro. $2.4 to the euro, right? So now let's see how much I'm getting. I think it was $1,000, right? Yeah, so they are going to, I'm going to sell to a US customer. He's going to give me $1,000. When I convert, how many euros will I get? Simple. Okay. So $1,000 divided by 2.4. So that will be 416.67. So that's how much I will get to hand. Okay. So 416.67, which is A. Right. So that's it for section A, right? So I'll quickly take attendance. We'll take a break and we can start off section B and C. Afzal Ahmed, right? on the initial and right, so it's 10:40 now. Come back at 11. We will continue. Okay, and we'll finish off. Okay, right. So let's move on to section B. Okay. Now let me tell you something about the exam, right? Section A, okay, section A, there is a chance that you can go wrong, right? Because it tends to be slightly tricky. Okay. Section B, it is kind of tricky, but you can get a lot of, a time advantage from section B, right? Because although each question is worth 10 marks, I don't think anybody will need about 10 into 1.8. No, so I don't think anybody will take about 18 to 20 minutes just to do section B. Okay. Now, section C, on the other hand, it's easier, comparatively easier than A and B. Why? Because all your workings examiner can see. Okay. So, even if you go wrong here and there, it's fine. There are chances for you to get marks, right? But in terms of time, it will take a lot more time to do section C. And section A also, if it is a calculation, then definitely it's not going to finish off soon. Although it's only for 2 marks, it will take a lot longer. So, usually B is where you get the time advantage. Okay, so make sure you know that, right? So, for example, there is a big scenario, 2 calculations and 3 theory questions means 3 theory is usually very simple for section B. It will be based on that scenario, so it tends to be simple. So, you tend to get the time that you're losing out in A and C, you tend to get it in B. Okay, right. So, let's continue. Right, so they're talking about a company called Gemford Enterprises. Okay, now it's made very easy for you in your exam. You have the question on one side, I mean the scenario on one side and whatever they're asking on the other side. So you don't have to go back and forth and all of that. Okay. And you can highlight, right? I'm not able to highlight now. Let me just check. Yeah. But again, if you use a laptop, you will be able to highlight. Okay. Right. So what does it say? It's a good idea before you read the requirement, before you read the scenario, to read all the requirements first. Okay, so let's do that. First one, they're saying determine the economic order quantity for the component A prior to considering a quantity discount. So asking for a EOQ. Then the next requirement is what's the financial consequence of getting a 2% quantity discount? So something to do with accounting for materials, clearly. Okay. Then about just in time. Then again, something theory about EOQ and something to do with early offering a discount. Okay, fine. So let's read through. Okay. Okay. So it says here, Gemford Enterprise specializes in manufacturing electronic gadgets. Due to previous challenges with suppliers' timeliness, Gemford has maintained a significant inventory of electronic components to ensure uninterrupted production. Okay. However, with recent improvements in supply reliability, Gemford is reassessing its inventory management strategies and recalculating the economic order quantities. One component labeled component A incurs a purchase cost of 1,000 per unit for Gemford. The expected annual usage of the component A is 65,000 units. Usage means demand. Okay. Gemford incurs procurement costs including order placement and processing amounting to 2,500 per order. Furthermore, the holding cost of 1 unit of component A for 1 year is estimated at 30% of the inventory value. Fine. Then they're talking about a discount. Okay, they're saying notably, Gemford supplier offers a 2% discount on the price of component A if an order quantity of 2,000 or more is placed. Okay. But this paragraph, I don't have to consider now itself because in this requirement, they're telling me to ignore that. They're asking for the EOQ before the discount. So I can ignore the discount portion. Then it's saying also one of the directors at Gemford has proposed exploring the implementation of the just-in-time procurement strategy for sourcing component A. So somebody is suggesting JIT. Okay, fine. So what do we need to use to get EOQ? Basically, just these two paragraphs. That's all we need. Okay. So I'll give you 2 minutes. I'm sure you know how to do EOQ, simplest calculation. Go ahead and get the EOQ. Okay, to the nearest whole number. So don't make a mistake and give it in decimals and stuff. Okay. Okay, so EOQ formula is given. I think it's the first formula in your sheet. Yeah, EOQ is there. Okay. Right. So let me quickly get the answer. So I'm talking about EOQ. So that is 2 times cost of ordering demand divided by the cost of holding, right? So let's put in the numbers one by one. Cost of ordering. So they're saying Gemford incurs procurement costs, including order placement and processing, amounting to 2,500 per order. That is only clearly the cost of ordering. Okay. So 2,500 into annual demand, right? So what is that? They're saying the expected annual usage of this component is 65,000 units. So that is only the demand. It's already annual, so no need to do any multiplication. And the cost of holding, they said, furthermore, the holding cost for 1 unit for 1 year is 30% of the inventory value. Purchase cost is 1,000. So 30% of 1,000 basically. Okay. That should give you the EOQ. 1,040.83, but they told me to the nearest whole number. Even if you put the answer as 1,040, it will be marked wrong. Okay. So nearest whole number means you have to round it up, 1,041. Okay. Now they're saying, what is the financial consequence of accepting a 2% quantity discount? Okay, so I have said this before, right? Now EOQ, if there are no discounts, we don't have to think twice. That is the quantity which minimizes your total cost. EOQ is the quantity that makes your cost minimum. So you don't have to think anything. You will go and order the EOQ 1,041 units and call it a day, right? But the moment a discount comes into the picture, sometimes there is a chance that the quantity at which you're getting the discount will give you a lower total cost. So then what you have to do, you have to calculate the total cost incurred at the EOQ plus the total cost incurred at the discounted quantity and then figure out whether or not the discount is good for you or not. Okay, so that's what we will do now. So I'll give you the structure. Usually this is how we do it. So total cost when ordering at the EOQ, which is 1,041. Okay. So when it comes to materials, there are three costs that we have to consider. One is the purchase cost. Then the ordering cost. And the holding cost. Each of them have a particular equation, right? So purchase cost is the purchase price into the demand. This is cost of ordering into demand over the quantity ordered. This is cost of holding into quantity ordered over 2. Okay, so now we need to do the purchase cost, ordering, holding for the EOQ quantity first, right? So the purchase price, I think it was $1,000, right? The question told me every unit was $1,000. So 1,000 into the demand was 65,000. So purchase cost will be 65 million. Okay. Cost of ordering one unit was 2,500. Demand is 65,000. Quantity, we are talking about the EOQ this time. So that's 1,041. That's 156,100. Okay. Then we have the cost of holding. They told me it was 30% of the purchase price, 1,000 into quantity is 1,041 over 2. Usually at the EOQ, the ordering and holding will be equal to each other. Here there is a small discrepancy, right? It's 156, 150. The reason for that is because this 1,041 is a rounded figure. If you use the exact figure 1,040.83, then both ordering and holding will be equal. Here, because we are using the rounded figure only, it's not equal. Doesn't matter because in the question they told us to round it. Okay. Right, so let's get the total cost. So add up these three. Okay. So that should give me 65,312,250. Okay. So that's the total cost when we order at the EOQ, right? Now, same thing you have to repeat for the discounted quantity. Okay. So take this down and try the discounted quantity as well. So total cost. Then ordering at discount. So discount was 2% and the quantity was, I think it was 2,000. Let me check. Yeah, 2,000 units or more means you get a quantity discount. Okay, so Q is 2,000. Okay, take it down and then try to get the total cost with discount. Okay, so same thing. I will also start it off. Three costs: the purchase cost, the ordering cost, and finally the holding cost. Equations are the same. P into D, cost of ordering to demand over quantity. Okay, and cost of holding into quantity over 2. Right, so price, now here there's a small change in the price, right? Because we are going to get a discount. So it's not going to be 1,000 anymore. It will be 2% less than 1,000. So 1,000 into 2% less, so 100 minus 2, 98%. Into demand is the same, 65,000. So that will be 63,700,000 we're talking about. Okay. Cost of ordering is the same, 2,500 into demand is 65,000. Quantity is 2,000 this time. That will be 81,250. Cost of holding is going to be 30% again into 1,000 into 98% into quantity is 2,000 over. So 1,000 into 30% into that will be 294,000. So total cost at 2,000 units will be at the 3, which is 64,75,250. Okay. Now compare these two. Okay, so this with this. So you can see if you order the EOQ, it will cost you 65 million. If you order at the discounted quantity, it will cost you 64 million. So if you order the discounted quantity, you are going to make a savings. Okay, so I will mention that as well. Okay, I don't know how that just disappeared. It's weird. Okay, I'll just put in the calculations quickly, okay, because in case you didn't get it. Purchase, ordering, holding, it's P into D, cost of ordering into demand and quantity. Okay, so that will be 1,000, 65. Okay. So the totals also quickly. The total is 64. Okay, so there will be a savings. It will be 65, this figure. 65,312,250 minus 64,75,250. So a savings of 1,237,000. $1,237,000. Okay, so you will have to check here. A benefit of 1,237,000 per year. Okay. Right, so that is this. Okay. Right, so last 3 was actually based on theory, right? So you can relax and just answer it, right? So it says here, in the context of procurement strategies, which of the following statements regarding JIT is true? A is saying JIT involves maintaining large inventories to ensure uninterrupted production. That's wrong. JIT means we will order the inventory itself only after the customer has placed the order. So we don't have inventory. That's wrong. JIT aims to procure goods from customers at the earliest possible time. That is also wrong, right? We wait until the last minute and then only place the order. JIT reduces dependence on suppliers for quality assurance and on-time delivery. Wrong. If you're doing JIT, your supplier has to be of, a person who gives you the goods on time plus with good quality. It shouldn't be a situation where, you place the order, he takes a long time to send it. After you get it, the quality is not good, so you send it back. If it's that kind of a situation, it won't work with JIT because already we are placing the order at the last minute, right? D is saying JIT implementation results in decreased inventory holding cost. That is correct. Why? Because we are not going to hold inventory in our warehouse at all. Only after the order is placed, we are going to go ahead and place the order for inventory. So where are we holding it at all? Right? So we don't have to incur any amount with regard to holding costs. The answer there is D. Which of the following assumptions are necessary for the application of the EOQ model? Okay, so you know the EOQ formula, right? It's 2 times cost of ordering into demand over cost of holding. So basically, cost of ordering has to be constant, demand has to be constant, cost of holding has to be constant. Then only we can use the EOQ model, right? So what does it say? Demand is known and remains constant, true. Okay. Lead time, meaning the time between placing an order and receiving it is going to be constant. That is also true. When it comes to EOQ, the lead time also has to be constant. If the lead time is not constant, EOQ does not hold true. Okay. C is saying ordering cost for each order and holding cost per unit per annum is known and it remains constant. Correct. Part of our equation. So A, B, and C. Okay, so answer that will be A. Let's read D and E as well. Replenishment costs are unknown. That's wrong. We know how much it is, right? How much we will have to pay to buy a new unit. Unit costs of item changes when the quantity ordered? No. Okay. If the unit cost changes in case there's a discount or something, EOQ does not give you the, for sure it will not give you the cost that is minimized. Okay. So E is also not the case. A, B, and C. So answer there is the first one. Which of the following are benefits of a company offering a discount to customers for early payment of invoices? So what will we get as a company? What's the benefit for us if we give our customers a discount for early payment? Okay. So better liquidity for the firm, definitely. Yeah. Why? Because they will pay quickly. So we get cash to hand quickly. So that's fine. Less interest as less or no overdraft will be required. That is also true because the customer is paying me money now. So why will I want to go to the bank and take a loan and pay an overdraft? I don't need it. Why? Because I have the money that I need. The customer has itself paid it, right? So that is also correct. Risk of more irrecoverable debts as customers take longer to pay. That's wrong. Okay, because they are paying early. The earlier they pay us, the risk of irrecoverable debts is actually lower. Okay. 4 is saying loss of customers who do not take advantage of the discount, not necessarily. If they don't want the discount, they will not pay early, they will pay late. They are not going to say, no, I'm not going to do business with you. No. Okay, so that is also not the case. So the answer will be 1 and 2. Okay. Right, so that is it for the first MTQ, right? So now we look at this company called Sunrise Enterprises, okay? Read the requirements first. It's saying determine the base equity value for Horizon Industries using the net realizable value basis, fine. Okay. Then they're talking about something to do with the price earnings method. Then they're talking about something to do with valuation again, but this is not a calculation. Then something to do with behavioral finance and something to do with, looks like something to do with again behavioral finance only. Okay, right. So let's look at the question. Okay, can you have a quick read through so I don't have to go through it again and again? Okay. So it says here, Sunrise Enterprises is contemplating making an offer to acquire Horizon Industries. So they are thinking of buying this company called Horizon Industries. It is expected that upon completion of the acquisition, the current management team of Horizon will retire, paving the way for new leadership. This transition is forecasted to generate a pre-tax salary cost savings of 30,000 per year. Fine. Then it's saying, since Horizon is not publicly listed, a published price to earnings ratio for the company is unavailable. So we don't have a PE ratio. However, Radiant Innovations, a comparable entity to Horizon, currently boasts a PE ratio of 9. So we can use 9 as a substitute because we don't have the PE ratio for the company in hand. Okay. The statement of financial position of Horizon Industries as of 31st December is as follows. You have non-current assets, current assets, inventory, receivables, cash. Then we have ordinary shares, reserves, loan notes, and payables. Fine. Additional details regarding Horizon Industries are as follows. They're saying the non-current assets that is worth 150 million have not undergone revaluation for several years, and it is estimated that their current replacement value is 300,000. So they're saying it's not going to be 150,000 anymore. It's actually going to be 300,000. They haven't revalued it, right? Then they're saying $10,000 worth of inventory is considered obsolete and it could be sold for 1,000. So the inventory that we have currently is 35,000, but in that 10,000 is obsolete, meaning we can't use it. So we have inventory worth 25,000, but that obsolete inventory, you can sell it for a scrap value of $1,000. So that is an option that we have. So we have to make an adjustment for that inventory figure. Okay. Then they're saying the earnings per share amounted to 85 cents with a corresponding dividend per share of 45 cents, and they're saying corp tax rate is 30%. Okay. Right. So the first requirement is determine the base equity value for Horizon Industries using the net realizable value basis. Okay. Now, if you are going to value a business, there are three methods. Either you go for the asset-based valuation, an income or earnings-based valuation, and a cash flow-based valuation. Okay. So in this case, if you are saying net realizable value, we are talking about an asset-based valuation. So you have to take all your assets and deduct your liabilities. That's a simple thing that you have to do here. Okay. Right. So let me quickly do that. So the assets that we have over here, non-current assets, inventories, receivables, and cash. Okay. Now, non-current assets, although in the books it says 150, they told me very clearly that it should be 300,000. Okay. So I can't take 150. I will take 300,000. I'll just mention it. Okay. Then inventory, if you look at the question, okay, so inventory, if you look at the question, it's 35,000, but in that 10,000 they said is obsolete, and that 10,000 you can sell it for 1,000, right? So 35,000 minus 10,000 because it's obsolete, but still it's not entirely lost. 1,000 you can recover. Okay, so actually inventory will be 25 plus 1, 26,000. Okay, what else? You have receivables and cash as well. How much were the receivables? Yeah, it can't move up, it's fine. Receivables were actually in the question 20,000 directly given. Cash was 2,000. So total assets is 300,000 plus 26,000 plus 20,000 plus 2,000, which is 348,000. So to that, you need to deduct the liabilities. There was non-current liabilities and there was a payables. Non-current liabilities was this loan notes of 80,000 and payables is 18,000. So 80,000, 18,000. So it will be the net realizable. Okay, very, very simple. So you can put that here, 250. Don't put commas, okay, at your exam. Just put the number as it is. Right. Now it says, based on the most recent earnings per share, what is the equity value using the PE ratio method? Okay. Now, if you are using the PE ratio method, there is an equation to get the market value of the company, right? They're asking for the equity value, no? So how do we get it? There is an equation. So market value equals to the PE ratio multiplied by the total earnings of the company. Okay. Now, if you look at the question, they are telling me that the PE ratio of 9 can be used. So I can just use that 9, no problem. Okay. How do I get the earnings? So they told me something about earnings per share, right? They said it's 85 cents per share. Okay. So if I want to know the total earnings, 85 cents into the number of shares will give me the total earnings. So how many shares do I have in issue? It was a book value of 25,000 and the nominal value is 0.25. So 25,000 divided by 0.25 will give me the number of shares in issue. Okay. So I will get that figure. 9 into earnings per share was, they told me, 0.85 into number of shares. So that is 25,000 divided by 0.25. That will give me the market value, which is 765,000. Simple calculation. Okay, so this has to be total earnings. So that is why I am multiplying it by the number of shares, right? So this is the number of shares. Okay. So this will be 765,000, which is B. Which valuation method would be advisable for Sunrise Enterprises if their intention is to purchase Horizon Industries and subsequently dispose the assets individually? Okay. Now I told you there are 3 methods, either asset-based, income-based, or income or earnings-based, or cash flow-based. Okay. Now the first one they're talking about, the dividend valuation model. This is used if you're going to use that company's income. Okay. So you're going to purchase the company with the intention of using its income. So if you're going to have that intention, using DVM is good. But here we are not keeping that intention. We are buying the company with the intention of selling the assets off. We don't want to run the business, right? So DVM is not a good option. NRV, net realizable value, is an asset-based valuation method, right? Remember, if you are going to buy a company just to sell its assets and not to run the company, then the best valuation method will be an asset-based valuation. So in this case, NRV is the best one that we have. PE ratio, if you look, again, it is used only if you're going to acquire a majority shareholding and you have the intention of running the business. In this case, again, we are not running, right? So the only option that is suitable here is the net realizable value method. We call this asset stripping, if you remember. Okay, you buy a business just to sell off the assets, and that's about it. We don't want to run the business. Okay, right. Then it says Horizon Industries Finance Manager believes that their actions will directly cause an increase in earnings and a corresponding rise in the firm's share price. Which behavioral finance concept does this belief exemplify? Okay, so basically a concept where people within the organization are saying whatever we do is only correct. Okay, when whatever we do, whatever decisions we take will cause the share price to increase. If you can't remember this, this is actually part of the study hub. Okay, it's called behavioral finance. Just have a look at it quickly, because since they have mentioned it in the pre-mock, there's a chance that they might ask you to explain something about it, right? So take note of this particular area. It should come in one of the first few chapters. Okay, chapter 1 or chapter 2. Just read through it and make sure you have an idea of behavioral finance, right? So this kind of a situation where, we feel that we're doing the right thing, we call that illusion of control. Okay, so there is no way you would know this unless you have read that part of the study hub. Okay, right. Then it says, which irrational behavior of investors involves following the crowd, often leading to stock market bubbles, right? Now, this happens by, some people do this, right? What they do is they don't take a decision of their own head. Okay, so they don't take a decision based on their understanding and their intelligence. What they do is they will follow somebody else's actions. So like they keep an eye on a few investors, maybe the major ones. And if the major ones are selling shares, these people also sell. If they are buying shares, these people also buy. So basically we are kind of following somebody else, right? So what is that actually called? It's called herding. Herding, if you can think about it, it's like, say a herd of cows. Cows are not going to think whether, okay, this is the correct direction. No. Whatever the one in front is doing, the one behind will also do. Right? So same thing here. Whatever another investor is doing, these people also do. They don't necessarily take their own decisions. So this is called herding. Okay. So again, this is all part of the study hub. Please do have a read through, because usually they don't ask, but since this is part of pre-mock, I have a feeling in section C, they might have a little bit to do with theory with regard to this area. Okay. Right. So that's it for Sunrise Enterprises. Now we move on to the last section B question. So we have section C after this. It's about Velco company, and this is entirely to do with risk management very clearly. Okay. How do I know? Because I can see a lot of exchange rates. Okay. Right. So quickly read through it and we can start. Okay. So it says here, Valco company, a UK-based company, anticipates a receipt of $240,000 in 1 month's time, followed by a payment of 140,000 at the same time. So you're going to get 240. We are based in the UK. We are going to get dollars. So we're going to get foreign currency of 240, and we have to pay also $140. Okay, so whatever hedging we are going to do, we don't have to do for 240 separately, 140 separately. We can net it off first and do it for the remainder. Then it's saying it also expects receipts totaling 300,000 in 3 months' time. So in 1 month time, the 240, 140 happens. In 3 months' time, the 300,000 happens. Finance manager has collected the following information: spot rate, 1 month forward rate, and the 3 months forward rate is given. Money market rates for Valco: 1 year sterling interest rate, borrowing deposit, and the dollar interest rate, both borrowing and deposit. So clearly, we might have to do a money market hedge. Okay. A is saying calculate the expected net sterling receipts in 1 month time using the forward market. So if we are going to hedge using the forward market, how much sterling pounds will we get? Okay. Right. So it's a forward, right? So let's see. We are going to receive 240,000, and at the same time we have to pay 100,000, 140,000. Okay, so first let's net it off. Okay, so 240 minus 140, it's a net receipt of 100,000. So this 100,000 we are going to hedge using a forward. Right. So what are the rates that we have? So it's happening in 1 month. So 1 month forward rate is $2 to $2.5. So now we have to decide, is it the lower rate or the higher rate, right? So we are based in UK. If somebody comes and gives us dollars, we don't need the dollars. What will we do? We will sell the dollars, meaning the bank is going to buy from us. The bank always buys at the higher rate. Okay. So the two rates that we had was $2 and 2.5. They will always buy at the higher rate, which is $2.5. So 2.5 to the pound, right? So how many pounds will we get? Basically 100,000 divided by 2.5, which is 40,000 pounds we will get to. Okay. Right. So you need to put 40,000 here. Then they're saying calculate the expected sterling receipt in 3 months' time using the forward market. So in 3 months' time, you're going to get a receipt of 300,000, right? So again, what will happen? I will get the dollars. I don't want it. I will sell it. Bank will buy high. But this time, 3 month forward rate has to be used. So that will be 2.5 to 3. Bank buys high means we are going to convert at 3. Okay. So simply, this is 300,000 divided by 3. So we will end up getting 100,000 pounds. Simple question. Okay. So this will be 100,000. Oh, by the way, you can see, right? Currency signs, all of them are usually given in the question itself. So you won't have to put a pound sign or a dollar sign when it comes to the MCQs. Okay. Right. What will be the equivalent pound value of the expected receipts in 3 months' time using a money market hedge? So this 300,000 receipt in 3 months' time, they're asking you to do a money market hedge, a full money market hedge. Okay. So I'll give you 5 minutes. Can you please try it out? Everything that you need for a money market hedge is there. So let me also do the money market hedge quickly. It's a receipt of 300,000, right? So in 3 months' time, what's going to happen? I'm going to receive 300,000, meaning this is an asset. That means today, what do I have to do? I have to do the opposite. I have to create a liability. So I can either borrow, I can deposit. Depositing means I'm creating an asset. If you want a liability, you need to borrow. Okay, so borrowing dollars, what is the interest rate? 1 year dollar interest rate for borrowing is here 12%. Okay, so borrow at 12%, that's the 1 year rate. So I want only for 3 out of 12 months. Okay, so now I will get the present value, right? So today I will borrow the present value of 300,000. That is 300,000 divided by 1 plus the rate, right? So 12 into 3 over 2 means we're talking about 3%. So I will borrow 291,262. Okay. I have this in hand. 291, 262. I have in hand. I am UK based. I don't want dollars. So what will I do? I will sell the dollars. Bank buys from me. They always buy at the high rate. So whatever the spot rate is, you have to take the higher figure. So current spot rate is 1.8 and 2. So you take the higher rate, which is 2. Okay. So how much will that be? In pounds, I will have 145,631 pounds. I have that in hand. Okay. So now what do? I will go and deposit this. So pounds, no, so get the deposit rate, right? So 1 year sterling deposit rate is 10%. So at 10%, but careful, into 3/12. Okay. So then finally, in 3 months, I will end up having in my account 145,631 plus the interest, right? So 1 plus 3/12 into 10% is, we're talking about 2.5%. Possible. Okay, I'm just quickly doing quickly, okay, because in case you haven't copied it down. Give me a minute, I'll just write it down again. Okay, so I will deposit this. So what I end up having is 145,631 times 1 plus 2.5%, which is 149,270. So yeah, the answer is B. Okay. That's how the money market hedge will look like. Okay. Right. So take it down if you haven't. Right. So 149,272 option 2. They're saying, what is the impact of a fall in a country's currency value? Okay, so if your currency value falls, will your exports be given a stimulus? Because export means what? Other people are going to buy from you, meaning foreigners are going to buy in your currency. Now, if your currency becomes weaker, with their currency, they can buy more goods from us. So yes, exports will be given a stimulus. Why? Because the buyer has more power in terms of currency. So if he can purchase more with a little bit of his currency, he will definitely be happy to purchase your goods. So exports will get a stimulus. Rate of inflation will increase. Yes, if your currency depreciates, we know that inflation will increase in that country. So both is correct. Both are correct, right? Which of the following characteristics is typically associated with a forward contract? They're saying the exchange traded forwards can't be traded on an exchange. Futures can be traded. Forward is something where you go to the bank, you fix the rate, you come, you can't sell that rate to somebody else. Okay, so that's wrong. They involve standardized terms and conditions. Again, that's not a forward, that's a future where you have standardized terms and conditions. So definitely not that. A forward is tailor-made. Okay, so you can make it according to how you want. Okay. 3 is saying legal binding contracts which predetermine the rate for a future transaction. That's correct. If you go to the bank and fix a forward, you can't, after that 3 months later, when the forward is supposed to happen, you can't, forget about it and not answer their calls. Okay. It is legally binding. If you go and agree, you have to honor that contract. Okay. So that's the answer. I'll just look at D. They are rights but not obligation to buy or sell. That is an option. Right and not an obligation is an option. It's not a forward, right? So yeah, that is the answer C. Okay, so now let's start with section C, okay? All right. So what is it saying here? I hope it's clear to you. Let's check. Okay, give me a minute. I think it's fine. A is saying calculate the net present value of the investment project and comment on its financial acceptability. Okay, so nothing to think of here. It's a normal NPV calculation. Okay, so what we will do is, let's quickly read through this. I'll give you a minute to read through it. And then I will start off with the calculation. Okay. Okay, it's clear. If you are comfortable, you have the question, you can also do it. We have done so many NPVs at this point. Okay. So let me see what it says. Nexus PLC, a prominent player in the automobile industry, is in the process of planning to set up its own engine oil processing plant. The initial market survey incurred a cost of 25,000 and the investment is estimated to be 800,000. Now this initial market survey is a sunk cost. Okay. So in this situation, always write that somewhere. Sometimes you get a mark for mentioning that. Okay. So say the initial market survey cost of $25,000 is not relevant to the calculation since it is a sunk cost. I mentioned that. Okay. Then they're saying the initial investment is 800,000. We have to use that. This new project life is expected to be 4 years and the company expects a scrap of 250,000 at the end of the project. Demand projections are as follows. So demand in year 1 is 2,000, then 4,000, 6,000, 8,000. Fine. Selling price is 100 and the variable cost is 30. Annual fixed cost is estimated at 100,000, which includes 60,000 depreciation and 10,000 of an apportioned headquarter costs. Again, depreciation and apportioned headquarter costs you can't consider. They are not relevant, right? It has to be future incremental cash flow. Depreciation is an accounting adjustment and apportioned overheads are also not relevant, right? So from the 100,000, you have to deduct 60,000 and 10,000. Okay. Right. So let me set up the structure. Net present value, right? So let me start with the sales income. Have years not 1, 2, 3, and 4. So if you look at year 1, I know that the demand is 2,000 and the selling price was 100. So it will be 200,000. Then in year 2, the demand, they're telling me it's 4,000. Selling price is still 100. That's 400,000. Then in year 3, 6,000 into 100. Put the formulas because then even if you make a mistake, examiner can, give you the mark for your calculation. Okay. Then 8,000 demand into 100, 800,000, right? So that is the sales. Okay. Then we have the variable cost. So here also they're telling me the variable cost is $30 per liter, right? So I'll put it as a negative figure. So 30 into 2,000, the demand, which is minus 60,000. Then 30 into demand, which is 4,000. To 6,000, the demand into 8,000, which is 240,000, right? Then we have the fixed cost component. They're telling me it was 100,000, but you have to deduct the 60,000 and 10,000. So that will be 100,000. Okay, this you don't need the working because it's straightforward. So 100 minus 60, 40 minus 10, 30, right? So I'll just directly put it as 30,000. I can copy it to all this. Okay, so that is the main part. Okay, so now you can underline this. And now here we take a total, we call it the operating cash flows. I'm just taking totals. Okay, so 110,000, 250,000, 390, and 530,000, right? Now, from this only, we will make adjustments for tax. Okay, so let's see what they're talking about the taxation. They're saying Nexus pays corporation tax at a rate of 33% and it's payable 1 year in arrears, right? So I can consider tax over here. So tax expense, it's going to be 33%, but paid 1 year later. So 33% into 110 will happen in year 2. That is 36,300. Put as a negative figure. Then here it will be 33% into the previous year's figure, which is 82,500. This is 128,700, and in the last year, year 5, $174,900. So that's the taxes, right? Then they're saying, they're talking about working capital. They're saying working capital equivalent to 10% of annual sales is required at the start of each year and it's recovered at the end of the project. That's fine. Then they're saying cost of capital is 10% and they're talking about tax allowable depreciation. So I will quickly do that adjustment because I have finished off tax now. So I'll do tax allowable depreciation now. Okay. So they are saying you can claim tax allowable depreciation at 25% on a reducing balance basis. So let me do the tax allowable depreciation calculation. Call it working number 1. Okay. Right. So I have the years. Year naught. There is a cash flow. How much is that? It's the initial investment. Initial investment is 800,000. Okay. Right. So on this initial investment in year 1, I will claim tax allowable depreciation at 25%. Okay. So 25% into 800,000, that will be 200,000. So minus 200,000. That will give me the written down value at the end of year 1, which is 600,000. Okay. Like that, you have to keep on doing it for every year. Okay. So year 2 also, I will claim tax allowable depreciation 25% of 600,000, which is 150,000. Okay. So written down value, that is going to be 450,000. Then in year 3, again, I will claim tax allowable depreciation. 25% into 450,000, that is 112,500. Again, I get the written down value, which is 337,500. Now year 4, this is a 4-year project now. So year 4, what will happen? Scrap. So they're telling me the scrap value in the question. They told me it was 250,000. It's given here. Okay. So put that there, 250. Okay. And then you get a balancing allowance in this case, which is 87,500. Okay, so now we can determine our tax savings, right? So tax savings, how do we get this figure? It's always a multiplication of the tax allowable depreciation, right? So this into 33%, this into 33%, this figure 112,500 into 33, and the balancing allowance into 33. So our tax savings here will be 66,000, 49,500, 37,125. And finally here, 28,875. Okay, finally, you need to decide the timing. That's very important because everything is paid in arrears. This 66,000, you get it 1 year later. It's tax allowable depreciation for year 1, but it's actually the benefit you get the following year. So this is year 2, year 3, year 4, and year. Okay, so that is basically your tax allowable depreciation adjustment. Okay. Right. So now I can put these figures into my main statement, right? So I'll call it tax allowable depreciation. I can call it tax relief from tax allowable depreciation. Working number 1. Okay. So year 2 onwards only, we will see the benefit, right? So copy down those numbers, 66,000. Then I had a 49,500, 37,000, 49,500, 37,125, and 28,875. Okay. Right. So that's the tax relief from tax allowable depreciation. Okay. If you have any questions, you can ask me. Okay. Then finally, we need to get the working capital cash flows. Okay. So let me do the working for that as well. I'll give you a second. If you want, quickly copy this working down. Okay. So what are they talking about? Working capital. They're saying working capital equivalent to 10% of annual sales is required at the end of, at the start of each year and recovered after the project is completed. Okay. So what was my annual sales? I actually put it here now. So I'll copy that. 10% of this figure, I need it same as working capital. I'll share this screen. Okay, so sales volume is year 1, year 2, year 3, year 4. Okay. So working capital required not sure why that's coming. So I'll just put the heading here. Working capital cash flows. This will be working number 2. Okay. Right. So the working capital that I require is actually 10%, they told me, right? So working capital required, it will be 10%. So 200,000 means of that 10% is going to be 20,000, right? So 10% of 200,000, 20,000, this will be 40,000. This will be 60,000. This will be 80,000. Okay. But we need it 1 year before because they're telling me it has to be in place at the start of the year itself, right? So this working capital of 20,000, it should be available in year naught itself. So working capital cash flow. Here itself that 20,000 should be available. Then for year 2, I need 40,000, but I have already put in 20,000 the previous year. So the increment of 20,000 only I have to put in year 1. So that will be 20,000. Then in year 3 also same. I need 60,000, but I have already put in 40,000. So the increase of 20,000 is what I need to put. And here also I need 80,000, but already I have put in 60,000. So again increment is 20,000. Then finally in year 4, they said everything will be released. So the entire 80,000, it will be released. Okay. So let me put these as negative figures because these are outflows. 80,000 is an inflow, right? So this whole thing, you can take it to your statement. Okay. Right. So we have that as well. Now lastly, just take the Okay, let's just take the initial investment and scrap. Yes, so initial investment, that was 800,000. So minus 800,000. And scrap was, I think, 250,000. Right, so 250. Okay, so that is that. So now you can take your cash flows, right? So let me take the total cash flow. Over here, it will be minus 820,000. You also take the total. We already had this 110 is a total, right? So 90,000. Okay, so just taking totals here. Okay, so now what you can do is you can get the net present value. Okay. Now, there are two ways to do it. I'll do it the normal way that we do by taking the discount factor. But you can use the formula on the spreadsheet if you are comfortable. If you are not comfortable, then no problem. Use the discount factor itself. Okay, so let me just bring this down a little. Can be a little difficult to do this on a tab, right? So one second. Always, when you're doing this, use a laptop, okay? Because if you use a tab or a phone, you won't be able to use this spreadsheet properly. Okay. Right? So we have the cash flows, take the discount factor. I think they told me, right? It was cost of capital is 10%. Okay, so just a matter of taking discount factor at 10%. Okay, so for year naught, it will be 1. Okay, then 0.909. Okay, so let me go to the, okay, 0.909, 0.826, 0.751, 0.683. I'll show you how to do it with the spreadsheet also, okay, 0.826, 0.751, 0.683, and 0.621. Okay, so then multiply the figures, right? So present value. The figures, right? So this is 820,000. I don't know why it's not letting me formulate this. Okay, doesn't matter. I'll just put in the figures, okay, quickly. $81,810, and this will be 259,700 into 2. 5.2. This is 253,087. Four to 5 into 0.683. 52483. You might, when you're using the practice platform, guys, you might find it a little laggy. Okay. Don't worry, your exam won't be as, bad. Like, I mean, I'm not saying it will be very bad. Okay. But when you're using the practice platform, now see, for example, now it's for some reason not letting me press the equal sign and choose two cells. Okay. Now, maybe if you use a laptop, that won't be a problem, right? But there will be small issues, but you won't be facing lagging and stuff at your exam. Okay. So don't worry about that. Which is 90,682. 90,682. The negative. Okay, so now you can get NPV. It's not letting me formulate. Okay, so I'll get the total, okay, of the present values. It will be something close to 163,840. Okay, 116,840. So it took a lot longer than what it should because suddenly it's not properly letting me formulate, right? But otherwise, this is something you should be able to quickly finish. Okay. So I'm not sure if I can show you. There is a method to get NPV using the spreadsheet alone. Okay. So let me show you that also quickly. I think I have showed before. It goes like this. Equal sign NPV. You have to open a bracket and select. Okay. See, it's not allowing me to do it here. Okay. So just have a look at this. How it works is like this, right? Equal sign. You have to put NPV. Open a bracket and select all your cash flows other than the initial investment. So don't select the initial investment. Select 90,000, 259, 337, 768, 146. All of them you have to select and press the equal sign. That will give you an answer. No. From that answer, you have to deduct the initial investment. That will give you NPV. Okay. So that's how you use the spreadsheet function to calculate NPV. It's a lot faster. But if you're comfortable with this, it's fine because it will only take maybe 1 minute extra. Okay. But see, if there is a problem formulating and all of that, then yeah, it will take much longer. So in that case, it's better to use the spreadsheet method itself. Okay. Right. So that's the NPV. So it is positive. You have to accept the project. Mention that you get a mark. Okay. So since NPV is positive, the project should be Accepted. Okay, so just mention that. Right, that's it. You get your 12 marks. Okay, easy 12 marks. So that is your table. By the way, guys, the answers to the pre-mark, it is available. Okay, so it is available. If you want to access it, it is there in the practice platform itself. Okay, right. So let's move on to the next one. I didn't expect that to take so long. It took long only because I couldn't do the formulation on the sheet. Okay, if not, it's usually much faster. Right. We might have to go on till a little later. Okay, today we'll finish off the paper. Right. B is saying discuss two differences between NPV and IRR. Also, in the context of mutually exclusive projects, discuss which method is preferable. Okay, so they're asking you two differences between NPV and IRR, and if you're having mutually exclusive projects, which one is preferable? So 5 marks, better to get 5 points. Okay, C is saying comment on the financial manager's preference to NPV for investment appraisal. So if you look at the last point, it says the CFO suggests that using NPV for investment appraisal, he's suggesting using NPV, emphasizing the method's alignment with long-term objectives. However, some finance managers express concerns as their performance evaluations and compensations are more tied to annual profits. Okay, so I'll show you the answer that they're expecting here. Okay. Okay, so how do you know, go and get the answers? It's in a tab called mark. Okay, so under self marking, you should have the December mark. Only after you try the paper, they will give you access to it, right? So I'll quickly finish off this paper, so I will get access to the marking scheme. Okay, so just give me a second. Okay, so only when you press on the left hand side end exam, it says, are you sure you want to end it? You have to say yes. Only then the marks will be, the marking scheme will get available to you here. You can see now when I go to mark, I have pre-December. Okay, so now you can self-mark if you want. So just to show you the answer to that question, okay? So let me go to that particular question. Because so you can see question sample answer, right? Click on that. Right. So these are the differences between NPV and IRR, what they're trying to say, right? So it says here, first thing, NPV looks at absolute increases in wealth, and so it can be used to compare projects of different sizes, whereas IRR is looking at relative rates of return, so it ignores the size of investments, right? So if you look at the NPV answer, it comes as a dollar figure, whereas IRR is a percentage. So absolute figure means you can compare any sized investment, no problem. Whereas when it comes to a relative figure, we can't compare investments of different sizes. So that is one point that they're saying. Then they're saying NPV is not subject to technical difficulties which limit the usefulness of the IRR method. I have mentioned this before. If there is a project that doesn't have a conventional cash flow, meaning there is an initial investment, after that every year there is a inflow. If you are not having that kind of a pattern, you will calculate multiple IRRs. So in NPV, you don't have that problem, right? So IRR technical difficulties are there, right? So that's the second point that they're saying. Then it's saying the NPV of a proposed project, if calculated at an appropriate cost of capital, is equal to the increase in shareholder wealth that the project offers. So if the cost of capital is correct, then the NPV is basically how much the shareholder will earn from that particular project. In this way, NPV is directly linked to the assumed objective, which is maximization of shareholder wealth, whereas IRR calculates the rate of return. Although this can show the attractiveness to the project to shareholders, it does not give exactly how much their wealth is increasing by. Okay, so that is the other thing. NPV, they know by 163,000, my wealth will increase. IRR, they can't mention that. So it says here, finally, one more thing, NPV, the accept and reject decision is very straightforward. If it is positive, accept. If it's negative, reject. Whereas IRR, you don't have a clear-cut decision rule. Okay. Then in that question, they had asked about mutually exclusive projects, meaning you can only do one project, you can't do the other. If you do one project, you can't do another project, right? So in the situation of mutually exclusive projects, it's possible that IRR may rank the projects in a different order to NPV. IRR assumes that any net cash inflows generated during the life of the project will be reinvested in the IRR, whereas NPV assumes a reinvestment rate equal to cost of capital. Generally, NPV's assumed reinvestment rate is more realistic, so it ranks the project correctly. So what we're trying to say here is, if there is a mutually exclusive project, IRR gives one decision, NPV gives another decision. NPV's decision will always take superiority because NPV is a superior investment appraisal technique. Okay, so if you can mention those points, you will get your 5 marks. Okay, right. So that is the 5 marks there. Then they're saying comment on the finance manager's preference for NPV. Why does he prefer NPV compared to other methods? So he's saying for investment, saying that the method is aligned with long-term objectives. Okay, so let's see what they're saying here. It's saying NPV is based on the assumption to seek shareholder wealth maximization, whereas managers will prioritize profits because their compensation, their bonuses, all of them might be aligned with profits and not shareholder wealth maximization. So this can create a situation where managers focus on optimizing short-term results to reach performance targets, even if it means that long-term value is sacrificed, okay, as measured by the NPV. So managers' remuneration depends on the level of profit and not on the long-term return. Thus, managers may be unwilling to take risk on large expenditure on projects that only offers good long-term results. So usually managers tend to not accept NPV. So NPV happens to be a good option if you're thinking for the benefit of the shareholder. But if you're thinking for the benefit of the manager, if his compensation, if his salary, if his bonus is all going to be linked to profit only, then he might not be willing to use NPV as a investment appraisal technique. That's what they're trying to say here. Okay. That should give you, I think, 3 marks. So you can just mention something that comes to your head at that time and call it a day. That's about it. Okay. Right. So that's that. Let's quickly do the last one as well. So we need to go to 30. Okay, so they're saying evaluate if the bright path proposal is financially acceptable to Luminex Corporation. Okay, there is something that they're talking about. I'll just read through the requirements. Okay, so that's A part. B is saying discuss the factors to consider in shaping the dividend policy of a public listed company in the stock exchange. And C is to explain any two Islamic financial instruments available to the business. So actually the B and C is very easy. Okay. Right. So let's look at how to do the A part. That's the only calculation. Okay. Can you quickly read through it? Clearly to do with working capital management, right? So again, guys, next week it will be entirely online. We won't be having classes on site. We will be doing a mock exam. Okay, so it will be from 8:30, 9:30, 10:30 to 11:30. And email me your answer scripts. I will go through each of them individually and I will give you personalized feedback. So I will send you your marks together with what I think, where I feel you should improve via email itself. So please send me an email and if possible, send me a WhatsApp message also confirming that you sent. Okay, because there was, I think, one situation in the last mock where one person said they sent it, but I didn't get it. Okay, so please make sure that if you send it, send me a message also and wait until I reply to that message to confirm that I have seen your answer script. Okay. So what are they saying? Embarking on a journey to refine on its working capital management and to increase dividend payouts, Luminex Corp's financial manager is actively seeking strategies for improvement. Fine. Luminex Corp generates annual revenue from credit sales amounting to 36 million. So their revenue is 36 million. Despite requiring all credit customers to settle invoices within 30 days, customers often take longer. Roughly 0.5% of credit sales result in irrecoverable debts that remain outstanding and unrecovered. Fine. Then they're saying trade receivables currently stand at 5 million and Luminex Corp incurs a short-term finance cost of 8% per year. So if the receivables is 5 million, until the receivables pay me, I have to take a loan of 5 million and pay 8% on that loan. Okay. Considering a proposal from a factoring company. So problem seems to be the fact that we're not getting the money quickly, right? So factoring company, Brightpath offered to manage its sales ledger on a with recourse basis. Fine. Brightpath aims to leverage its expertise to reduce average trade receivable days to 20 days while cutting irrecoverable debts by 80%. Okay, so what are they promising? They're saying currently people take 30 days. No? We will make them pay within 20 days and you have irrecoverable debts of 0.5%, bad debts of 0.5%. They're saying we will reduce that by 80%. Okay, so currently you have 0.5% into 5 million, no? That figure, we will reduce it by 80%. That's what they say. And they are also going to lower admin costs by 120,000 annually because if you go for a factoring company, you don't need to have a credit control department internally. So which means what will happen? You will make a savings. Yes, Fatima, mock will start on Saturday at 8:30 a.m. Okay. I know that some of you might have problems doing it at that time and all of that. So I'm giving you a deadline. I'm talking about 30th of November, Saturday. Send me your answers before the end of that day. Okay, simple. I've made it very simple. Before the end of that day, meaning before basically 12 midnight on Sunday, send it to me because I will be marking on Sunday. So if you send me your answer script on Sunday morning or Sunday evening, then there is a chance that I might not have time to mark it. Okay. So if you want proper feedback, please attempt it by Saturday and send it across. At 8:30, the Zoom meeting will start. Okay, so I will be there online. So in case you have questions and stuff, you can always ask. But if in case there is a chance that you're not able to do it at that time, before the end of the day, I want the pay. Okay. Right. So there is going to be an admin savings. As part of the factoring agreement, Bright Path would advance Luminex Corp 70% of the invoice value at an interest rate of 9% per year, and they charge a fee of 1.25 of the credit sales. Assume that there are 360 days in the year. Okay. So they're saying, is this proposal that Bright Corp, whatever they're proposing, is it financially acceptable or not? Let's see. Okay. So let's see the cost that we will incur if we are going to manage in-house. Okay. So in-house management. So what and all do we have to have, right? So what's going to happen if you're going to do in-house? First of all, that 5 million, that receivables figure, you will have to take as a loan. Okay. So we will have a short-term finance cost. Short-term finance cost. Okay. How much is this short-term finance cost? That is 5 million. Into, I know that it's a short-term finance cost of 8%, right? So 5 million into 8%, I will have to incur. So that is how much? 400,000. First thing. Okay. Then, if I do it in-house, I will have irrecoverable debts of 0.5% of sales. So irrecoverable debts, that's going to be 0.5% into the sales figure, which is 36 million. So that is 180,000. This is another cost I will have to incur. Okay. What else? They said that if I go for factoring, I will save on admin cost of 120,000 annually. That means if I don't go for factoring, I will have to incur that 120,000. So that is only my administrative cost. Audit administration cost of 120. Okay, is there anything else? That's all I will have to incur. So total cost in-house. Take a total here. 580, 680, 700,000. Okay. Okay. Right. So now let's see the same thing if we are going to go for factoring. Okay. So let me call this. Right. So factoring service. Right. So if you're going to go for factoring service, they're saying that they will give me. So you can see, considering a proposal from a factoring company, it's a with recourse basis. They're saying that they will reduce the receivables to 20 days while cutting irrecoverable debts by 80%. That's fine. And lower admin cost by 120. That's also fine. Then they're saying, as part of the factoring, they will advance 70% of the invoice value at an interest rate of 9% per year. So that is the first cost, right? So factor finance cost. Okay. So if you look at the factor finance cost, they're telling me they're going to make it 20 days now. So the receivable is going to become 20. So I can calculate the receivables using that, right? So the equation is this. Okay, so I know that this is the equation. So receivable days equals to receivables over sales into, they told me to use 360, right? So if the receivable days is going to become 20 days, then what will the receivables be? I need to calculate, right? Sales is 36 million into 360. Okay. So what is the receivables going to be? Let me check. Yeah. So receivables will be 2 million. Okay. So on this 2 million only, they are saying they are going to give me 70% in advance itself, right? So 70% of 2 million, and I will have to pay them an interest of 9%. Okay. So basically, how much will the finance end up being, right? So that will be 36 million divided by 360 into 20 million, sorry, 20 days. That will give me the 2 million. Of that, I'm going to get 70%. And on that 70%, I need to pay 9% interest. So the finance that I will end up having to pay is 126,000. Okay, that's the factor finance cost. Okay, then they're telling me that they will charge a factor fee of 1.25% of credit sales. So I can put that easily. Factor fee 1.25%. Credit sales was 36 million. Not 0.25, 1.25. Okay, so that will be 48,000. Sorry, not 48,000, once again. 450,000. What else do I have to consider? Right, let me check. Then they're saying irrecoverable debts, right? So irrecoverable debts. They're saying they will reduce it, right? So it was 36 into 0.5, but they will reduce it by 80%, means now it's going to be 36 into 0.5 into 20%, because they're reducing it by 80%, right? So irrecoverable debts, how much is that going to be? That is 6,000. Okay. So that is what they have given me straightforward, right? Nothing else they're mentioning there. Yeah. So one last thing, it's not direct, it's a little indirect here, right? So if you see here, they're telling me this 2 million, that is 6 divided by 360 into 22 million, only 70% they will give it to me in advance, right? Meaning the remaining 30%, I have to go to the bank and take a loan and, pay the normal overdraft rate. So normal overdraft rate for me is 8%. Right? So for that remaining 30 million, I will have to incur that fee. So that is not straightly given in the question. You have to mention that. So I will call that finance cost on receivables balance. Okay. So that will be the same thing. This is not keeping 48. Okay, I'll type it again. So I'm talking about 36 million divided by 360 days into 20 days into the balance 30%, which I will have to pay 8%, right? So that will be 48,000. Okay. So that will be the total cost that I have to incur under the factoring service, right? So 126 plus 450 plus 36 plus 48. So total cost okay, so I'll just put the total over here. Should be 660,000. Okay. So if you look at in-house, it's 700,000. If you look at the factoring arrangement, it is 660,000. So obviously factoring happens to be cheaper by 40,000. Okay. So you can mention that savings. Or you can put it as a sentence itself, a saving of 60,000, not 60, no 40, can be made if the company opts for the factor the factoring arrangement. Therefore, the factoring arrangement is financially acceptable. Okay, so you just need to mention that. Right, so that will give you your 8 marks. Right, so let's move on to the next one. B and C were entirely to do with theory, right? Discuss factors to consider in shaping the dividend policy of a public listed company in the stock exchange. 6 marks. You can make 3 explain points, that will be it. And C is saying to explain 2 financial instruments. So I'll just quickly show you the answers to that. Okay, so 34. Something's up with, I guess, because we are coming towards the end. Right. So they're asking what we need to consider if we are going to go for a dividend policy, right? So in this, you can choose about 3 or 4, even if you can mention 5, it's fine, right? So first one is easy, sustainability of the business, right? So when you're deciding the dividend policy, what they're trying to say is make sure that if you're paying a particular dividend today, you can pay that into the future as well. So don't, settle for a figure that you can only pay this year and next year you won't be able to pay, right? So that is the first thing, sustainability. Next is law. Sometimes according to your legislation, you might be allowed to pay only a particular amount of dividend. So if there is a legislation like that, that is going to definitely impact the dividend policy. Okay. Third, they're saying covenants. Covenants means if you have bank loans, there might be certain clauses which say you can't pay a dividend more than this percentage. If that's the case, then whether you like it or not, you can't pay more than that. So you have to make sure that you honor that as well. Liquidity, again, if the dividend is paid by cash, if you don't have cash, maybe you have profits, but if you don't have cash, don't waste time and try to, raise that money and all of that. Stick to an amount that you have in hand, which you can pay. So if you can make, say now I've already spoken about 4, no, you would have easily got 6 points, 6 marks at this point. Okay. Then there is the signaling effect also. Like for example, if you are paying a constant dividend, suddenly the dividend is dropping, your clientele might think that the company is not doing well. Whereas in reality, the dividend reduced because you invested in positive NPV projects. So just mention that as well. Okay. So you can go through this just to give you an idea of what can be said. C was to talk about 2 Islamic financial instruments. So they're talking about Mudaraba and Murabaha. Okay, so it says here, a key principle is that charging interest and making money from money, lending a loan is forbidden under Sharia law. So providers of finance are more directly involved with the risk and rewards of the business. So you can choose any two, right? Murabaha, Mudaraba, Sukuk, okay, what do you call that? Musharaka, anything is fine, whatever you're comfortable with, okay? So here they're talking about Mudaraba. It's a partnership where only one of the partners, we call the Rabul Mal, contributes capital, and the other person, the Mudarib, he contributes skill and expertise. Okay. So the person who gives capital, he does not interfere with the running of the business. But in case that there is, you can see here, due to the fact that one of the partners is running the business and other is solely providing capital, investor has to rely heavily on the Mudarib, his ability to manage the business and his honesty when it comes to sharing of a profit or loss. But actually, there is more to this as well. In case there is a profit, there is a pre-shared ratio. Whereas if there is a loss in the Mudaraba contract, it is entirely borne by the Rabul Mal, the person who gives the investment. Okay. Then they're talking about Murabaha. This is something like a loan where you can see here it can be used for the purchase of goods for immediate delivery on deferred payment terms. Okay. As part of the contract between the buyer and the seller, the price of the goods, the markup, delivery date, future payment date, everything is agreed. Sale of the good is immediate, but the payment is done in installments. Okay. So you can explain. I have given you in detail how all of these work. So choose any two and you should be able to explain. But sometimes they will tell you explain suhu or explain musharaka. So in that case, you can't go and explain mudaraba obviously. So make sure you know all of them well. Okay. Right. So that is it. You should get how many marks there? 6 marks. Okay. So 3 points each. So it has to be well explained points. Okay. Right, guys. So that is the end of the pre-mock. Okay. So ACCA has what we call debrief videos, but they don't look at the MCQs in detail. That's why I did the paper. But if you, by any chance, want to go through something or, you just want to have another perspective, everything is available here. No, you can expect the same difficulty. It won't be more difficult than this. Okay? Okay, Fatima. Fatima is asking, is the real exam going to be like this or will it be more difficult than this? I don't think it will be more difficult. Okay, it won't cover as many areas, but you should be comfortable with theory, you should be comfortable with calculations and so on. Section B and C is very similar to a normal exam. Section A in this pre-mock is a little it has covered a lot more areas than usual. The reason for that is because it's a mock exam. So they want you to, kind of get exposure to all those areas before you sit for the real paper, right? Okay, then I will see you on next Saturday, 30th, online with a mock exam. I will share it at that time. Okay. Okay, guys, then if you have any questions, please reach out to me. I will be more than happy to help you. Okay, and all the recordings, everything should be uploaded at this point. So in case you want to refer to anything that we did today, you can always do that. Okay. Right, then that's about it. I'll see you next week.